Welcome to Yahoo Finance this morning. I'm Brad Smith alongside Shauna Smith. Happy Jobs Friday. Everybody celebrates. We're just 2 minutes away from all important September jobs report here. Non-farm payrolls, they're expected to show a gain of 150,000 jobs added for the month of September. This number will be a major factor into what the Federal Reserve does with interest rates come November here. There you're taking a look at the expectation on the unemployment rate as well as the year-over-year wage growth. That's anticipated to come in at 3.8%. The average hourly earnings month-over-month anticipated to show some growth here, Sean, of about 0.3% coming into this.
Yeah, exactly. I mean, you take a look at the prior 2 months, weaker than expected. Of course, a lot of people are closely watching this print, whether or not a much weaker report, what exactly that signals for the strength and stability or lack thereof, I should say, weakness that we could be starting to see within the economy. And then, of course, a stronger report. I think the conversation is going to turn about whether or not maybe that calls for the Fed being a little bit more hawkish going forward. And maybe obviously we could see a bump up in the expectations or likelihood that we will just get a 25 basis point cut instead of 50 at the next meeting. We know very much that CME Fed Fund futures, it's not too large of a difference, not too large of a gap in between the expectations of 25 and 50, especially when you forecast it out through the end of the year. But again, any change when you talk about inflationary pressures, what we could see in average hourly earnings on a month-over-month basis, the expectation there is for a rise of 0.3%. That would be slightly slower than what we saw the prior month's reading of an increase of 0.4% year-over-year basis. We're expecting 3.8% increase. That would be flat from the prior reading. But again, lots of emphasis on this report. And we talk so much about the importance of the labor data, how closely the Fed is watching this labor data. And this is the most important jobs print since the last print. And then the last print was the most important one since before that. So again, that narrative not really changing as we do countdown to this jobs print and exactly what this is going to tell us. And it is a massive beat. Are you looking at this number here?
I am.
Huge beat to the upside. You're looking at 254,000. The survey, again, expected 150,000, pointing to a very strong labor market here, at least looking at those headline numbers. Unemployment rate of 4.1%, slightly lower than what was expected, also slightly lower than what we saw last month at 4.2%. But when you take a look at average hourly earnings, that was increasing a bit more than expected, coming in a bit hotter at 0.4%. The expectation, again, was for a rise of 0.3%. But that headline number, I did a double take there, 254,000, but 100,000 more than what the economists have been expecting.
Yeah, taking a look at the futures as of right now, you're seeing a rise across the board here. The Dow, the S&P 500, and the NASDAQ are in the green, fractionally as they may be. You're seeing them jump off of this report here right now, and a few of the other factors as we're taking a look into some of the other metrics really coming in line with expectations. You got labor force participation rate, and then additionally here, taking a look again at that unemployment rate. It actually ticked lower right now, sitting at 4.1%. That's the actual versus the expectation of 4.2% here. So that is another considerable move that we're tracking here. In addition to that headline, 254,000 jobs added during the month. Kind of looking into some of the sectors as well here as we continue to kind of pour into this employment situation for the month of September. Some of the largest areas where employment continued to trend up: food services and drinking places, healthcare, government, social assistance, and construction here. And then there's also a note here. And of course, as we're navigating through hurricane season, the BLS certainly taking into account the different effects that has. They actually note within this one specifically, Hurricane Francine, because of the timing of the reading. Hurricane Francine made landfall in September in Louisiana on September 11th during the reference periods for the household and establishment surveys. Their analysis actually suggesting that Hurricane Francine had no discernible effect on the national payroll, employment, hours, and earnings from the establishment survey or the national employment rate from the housing survey as well. Joining us now to break down the numbers, we've got Robert Socken, who is the Citi Senior Global Economist, and Peter Chur, Academy Securities Head of Macro Strategy here. Great to have you both here on set with us. So just looking into some of the data here, I mean, a massive surprise to the upside on the headline print number, and then additionally a tick lower on the unemployment rate. Robert, just want to get your quick take on this print.
Yeah, I think this is, looking at the headline figures, very good news. And I think more broadly, feels a bit more consistent with some of the other dynamics we've seen in the economy, which is even as the labor market has been moderating, we've continued to see a fairly strong consumer that has continued to spend and not just on services anymore, but also maybe ticking up a bit on goods as well. And that impulse from the consumer has not seemed to slow down, even as we've had these softer data from the labor market. So this data is very good news. I think for the Fed, it puts them in an interesting spot and maybe pushes them more into what they signaled at the prior meeting, which is a pace of 25 basis point moves. I think especially with the unemployment rate ticking down, which Chair Powell said was the most important metric to watch, it's hard to see a lot of urgency to go as fast as they did at the September meeting.
Peter, just to get your quick thoughts here on the market's reaction, and we're looking at S&P futures gain, NASDAQ 100 futures also pointing to the upside. It's also important to point out, in addition to that headline beat that we got here this month, the prior month, the August non-farm payrolls, that was actually revised up to 159,000. What does this tell us then about the direction of the market? It looks like the market's taking as good news for the economy, good news here for the market.
Yeah, I think I probably would fade the equity good news. I think we're probably going to see maybe 4% on 10s because, as you said, this was really nice. We actually had upward revisions for the first time in a year, I think, or maybe second time in a year. So like that, almost all the beat came in the private payroll. So it's 223,000 jobs in the private payrolls. So that's good. You want to see that sector doing well. I don't think the Fed's going to like, though, that year-on-year wage is now 4%. So I think this pushes the Fed out a lot. I don't know whether we get 50 this year even now. They maybe 25 in November, but this may give them pause, right? This is a pretty strong report and contradicts some of what they thought. So higher yields, and then I think equities fade as that sinks in.
So it sounds like you think they can cut in November and then pause for the rest of the year.
Yeah, I think they probably still want to get at least one more cut in, given this. If we get more data like this, though, because they will see the November payroll, for another strong month, they may say, hey, maybe we have to keep this. And the other part to me, this is going to switch the conversation on the neutral rate a little bit. How far can they cut? I don't think they get anywhere close to 3% this time. I think it stays much more closer to 3.5%, and the market is not digesting that yet.
And so, Robert, with that in mind, I mean, that gives us the conversation around the terminal rate and where we think that the Fed may end things at. And as Peter was mentioning, I mean, this totally changes that type of calculus. What do you think this does for the conversation at the Fed? Even when we're going to get the meeting minutes from the last meeting, going forward from here now, that's what's really going to shift, it seems like.
Yeah, absolutely. I mean, and right now, the Fed feels pretty confident that they're far above wherever neutral is. But they've also recognized that they don't know where that endpoint that they have to go is, and they'll kind of feel it out as they move through the data. So I think there's no doubt where we are now, rates have to go lower. But yeah, as they start to cut further, especially if the data remain as resilient as they are, that's going to bring into question where that neutral rate is, especially as you said, if inflation starts to take up. I don't think that's where we are now. I view the upside risk to inflation as much more limited than it was earlier in the year. And I still think inflation is going to move back down to target. But we've seen cautionary tales elsewhere around the world. I mean, if you look at Brazil, they paused their the cutting cycle, and then now we see them hiking again, given the economy and inflation have been more resilient. So there are cautionary tales around the world, but there's no doubt, at least where they are now, the Fed has to go lower from here.
Peter, in terms of how this changes just the narrative inside the Fed, I know you're talking about just exactly what this will look like, maybe the conversation surrounding the next two meetings, but then looking out to 2025, what does that then tell us about future moves here for the Fed and maybe what that more realistic neutral rate might be?
Yeah, so I think it kind of brings, okay, they were so worried about jobs, that's been their fixation. I don't think they have to be in panic mode about jobs or really that worried. They'll keep a close eye on it. So I think it elevates their concerns about inflation. We'll see. China's been doing a lot of stimulus or announced a lot of stimulus. That has not really hit commodities much. So we could see maybe some inflation coming out of China. So I think it's now much more a balancing act there. And I really do think, right, they kind of thought 3% was kind of this neutral rate. Well, we've been chugging along in the economy at over 5%. Maybe the neutral rate's much higher, 3.5%, 4%. So I think they're going to digest some of that. I think this really makes them much more balanced again. And we have to go beyond just watching the jobs data and look at the inflation data as well again.
It seems like this is the type of report that could initiate some type of portfolio pivot if you are in the belief or in the camp that the Fed and the neutral rate has dramatically shifted off of this report. What does that play this morning?
So I think you see 10-year yields go higher, and maybe we break 4%, because I think a lot of people got very convinced that the Fed was going to cut a lot, that maybe we were seeing recessionary type data. We did not get that, so I think people are positioned a little bit bit too long in duration. We have auctions coming up next week in the 10s and 30s. That could put some pressure. So I think this is going to play out in the yield space more than anything. And I think as yields go higher, that's going to detract from the stock's initial rally.
Yeah, certainly. We are seeing yield spike right now in the aftermath of this print. Robert, when you talk about the health of the overall economy, the odds of a recession here, clearly this points to the fact that the economy might be on even more stable footing than many have been forecasting. Does this at all, I guess, sway your forecast one way or another, just in terms of the confidence now that you do have in the U.S. economy?
Yeah, and it's interesting because if we go back to, let's say, prior months, everyone was focused on the SOM rule conditions being met. The unemployment rate had risen a fair amount from its prior 12-month low. Typically, that's an indicator of recession, but this cycle has felt very different in a lot of ways. Normally in those SOM rule episodes, you see that jobless claims have been rising for several quarters leading into it. People tend to be losing their jobs. We don't see that in this environment. The other thing that tends to happen when the SOM rules set off is the consumer tends to roll over, at least for a few quarters. And as I mentioned earlier, the consumer has been exceptionally strong, where the Atlanta Fed nowcast is tracking at 2.5% growth in the third quarter. So you're really not seeing the signs in other data that the economy's in recession. Really what it's been this time around is the labor market moderating has been sending those recessionary signals. But if you look around elsewhere in the economy, you're not really seeing that. So to me, this kind of reinforces what I see elsewhere in the economy, which is, the data still feel like a soft landing. And I think this reinforces that.
All right, Robert Sotkin, always great to have you. Peter Chur, thanks so much for joining us here at the desk, for both of you breaking down this very important labor market print. All right, let's get to a breakdown on everything moving after this report. Again, a huge beat on that headline number, taking a look at revisions, big moves here to the upside. You also have a lower unemployment rate. And Jared Blickery, we're seeing this all play out in the equities and bond markets here this morning.
Yes, we are, and gold as well. We'll get to that in a second. Let's start with equities. First of all, stocks, at least stock futures, like this report, and I'll show you what happened to Dow futures. Kind of a lackluster action, but really came alive before the report and jumped right after it. You take a look at the NASDAQ, and by the way, Dow is up about 45 basis points. NASDAQ up almost 1%, so a little bit more. You can see it was positive all night. And then here are the S&P 500 futures, up about 2/3%, so somewhat in the middle there. Then you take a look at the bond market, and I'm going to show you the 10-year U.S. Treasury note futures. So these move inversely to yield. That took a big dip to the downside. That means that yields are popping up. Across the curve, I've seen moves of up to 15 basis points. That is a pretty big move. But I think it's just signaling that a lot of the fears that we were heading into recession or already are in recession, those have been put on hold at least for a little bit of time. And I want to check out the gold market as well. We saw that take a little bit of a dip to the downside. It's still, I'm going to give you a 3-month chart so you can see it's still near record highs. It really hasn't moved that much, but nevertheless, it took a little dip. That may just be broadcasting the Fed not going 50 basis points, maybe a little bit less. But I think the risks were that the risks were to the downside for the U.S. economy. And so this report helps to quell some of those fears. Now I'm taking a look at sector action. The background color is what happened yesterday. So energy and tech, that's XLE and XLK. Those were the only two bright spots yesterday. But this morning we are seeing outsized outperformance in consumer discretionary. That's XLY. XLK is tech. That's up over 1%. Financials up 2/3%. Industrials. So we're getting a good mix of not only the mega cap sectors, but also some cyclical sectors as well. So this is all around a fairly good looking report. The wage inflation, now 0.4%, that did come in a little bit hot. That's going to be something people are focused on, but that might be a little bit of a good problem to have right now. Now here's our leaders, and guess what? China is in the forefront. ARK investment, so disruptive tech, that's number 2. Then we have retail stocks, and we have solar stocks. Pretty good smattering here. And I'm just going to leave us with some of the tech stocks. Here's NVIDIA up 1.5% in the pre-market, adding to 3% gains yesterday. And then here is a look at that disruption board. A lot of red yesterday, but a lot of green this morning. Guys.
Jared, thank you so much. Appreciate it, especially as we are just inside of 1 hour until the start of trade. A lot of movement on the back of this report. Before we go to a quick break, a quick recap of the jobs data this morning, and certainly to the upside by about 254,000. That's well above that expectation of 150,000 jobs added. Take a look at the unemployment rate. That also ticked lower right now at 4.1% versus the 4.2% that was expected. And the average hourly earnings coming in a little bit better than expectations. That's higher than expectations number for the year over year. That was 4% versus the 3.8% here. So hot and hot is what you're seeing within this report right now. We'll continue to break down and be back with more analysis on what this blowout report means for your portfolio. All this and much more on Yahoo Finance. The September jobs report showing 254,000 jobs added during the month. That's more than 100,000 jobs than expected here. Over 100,000 jobs than expected. The unemployment rate ticking down slightly to 4.1%. Our very own Madison Mills and Brooke DePalma joining us at the desk for a deeper dive here. So Maddie, let's start with you here. You're watching the labor union impact here. What did you see?
Yeah, this is going to be critical to watch as we head into the next NFP print, right? Because we know that so many workers are on strike right now. I do want to point out that we were just shy of hitting 4% on that unemployment number. So potentially an even better picture than what we're seeing in that headline. Having said that, average hourly earnings up 0.4% on the month. That beat the estimate, which was 0.3%, and average hourly earnings are up 4% over the past 12 months here. That wage growth, there is a question about whether that's running above what the Fed was looking for, but that's certainly going to be good news for those labor workers, those union workers who have been on strike. Whether or not that is enough to satiate them, of course, course, depends on their own contracts, but interesting to see that we are continuing to see that wage growth under the hood.
Yeah, Maddie, I wonder how much more confidence this also gives economists and forecasters out there, right? When we talk about the fact that the port strike was a real headwind or a potential overhang here for the economy, now that we do have this temporary resolution, it sounds like we're going to get potentially a final resolution in about 3 months, or at least it kicks the can down about 3 months. I guess how much maybe this is then factoring into those economic models and maybe some of the strength that we will likely then see here looking out into 2025.
Yeah, and it's interesting given also another stat that we were talking about with your guest Offset here, that labor force participation rate staying at the same level for the third month in a row. Does something like that continue to be a tailwind for the labor market heading into 2025, like you said? And moving forward here, do we get a pause from the Fed? Do we see the neutral rate changing for 2025?
Yeah. And Peter was saying we might in December.
Yeah, it was. Brooke, you're here on set too.
Yeah.
You're also watching retail.
Yeah.
What's taking place within that sector?
This is a critical season for retail ahead of the holiday. And so we've really been seeing ramping up hiring, or these retailers saying that they're ramping up hiring. We did see roughly 15,600 jobs added to the retail sector. That's far more than the loss in August, but it is less than last year. Last year in September, the retail sector added roughly 18,000 jobs to the sector. And that's largely in line with what we're hearing from these retailers, like a Target hiring 100,000 workers, Amazon hiring 250, Macy's hiring 31,000. For Macy's in particular, that is less than last year, and others are roughly in line with last year. And so it'll be interesting to watch out to see, given that this is a shorter season between Thanksgiving and Christmas, how this hiring ramps up and what consumer demand we'll see during that shortened time.
Yeah, I was going to say, Brooke, what do you think this tells us just about consumer demand? Because if retailers are hiring, they are preparing for a strong holiday season, that could point then to maybe stronger spending ahead.
Yeah, absolutely. And also what we're hearing is that UPS, they hired 125,000 workers for this holiday season. That's actually more than the 100,000 that they hired last year. And I think this really speaks to what we're seeing with this change in consumer demand post-pandemic. A lot more people shopping online, maybe less staffing needed in stores to accommodate what previously was a crazy Black Friday, a crazy Thanksgiving day. And so it really speaks volumes to where the consumer is going. But certainly we'll have to, wait to see how this all plays out. Many anticipating that we'll see more promotions in store, that consumers will still want to celebrate the holidays like they did in past, even if their wallets still remain pinched.
And Brooke, to your point too about the hiring we're seeing also, I know you've covered Amazon hiring workers for the holiday season. That's hundreds of thousands of workers that are going to be added if we do continue to see workers striking. That could offset that and certainly lead to another positive print moving forward here.
All right, Maddie and Brooke, thanks so much for breaking down very, very, very important parts of this labor market data that we got out this morning. Well, here to break it down even further, the September payrolls report. After the big surprise here to the upside, we want to bring in Elise Gould, Economic Policy Institute senior economist. Elise, it's great to have you here. So I think when you take a look at these numbers, catching many economists off guard just a little bit, the degree of the beat, also the fact that we saw unemployment rate ticking lower by just a bit. I'm curious just your first reaction, what you think this tells us about the state of the overall economy.
Well, it's pretty clear that the labor market continues strong. It was strong before, and this is another strong report. So I think it's very positive. Payroll employment is up, as you said, and also there were sizable revisions the last 2 months in the tune of another 72,000 jobs than were originally reported. The unemployment rate ticking down a little bit, that's felt mostly by men, actually. Also, you see that for Black, white, and Hispanic workers, all having that tick down in the unemployment rate. And as I said, the labor market was already quite strong. The prime age employment to population ratio, I would say my desert island measure of how the economy is doing, that has held steady. That is the share of the population that is 25 to 54-year-old with a job, that is still at a 23-year high. So it's quite strong.
With that in mind, I mean, we did see some moves higher on the wage front year over year as we were taking a look at that, coming in at 4% versus the 3.8%. As we're kind of looking at the wage growth figure, how concerned, if at all, does the Fed need to be that wages could actually spur some, or at least a resurgence in inflation at this juncture?
I really don't think wage growth is a problem at all, especially given the pace of productivity growth improvements over the last year. And we still have a very low labor share of corporate sector income. So I don't think it's a problem at all. And we've seen inflation continue to come down.
Elise, does this, I guess, raise the confidence in a soft landing? Does this also bring back into conversation that no landing scenario at this point?
I think it's pretty great, right? So the expectations that the Fed was going to lower rates, maybe in this, obviously, the fact that they lowered rates happened after this jobs report came out. But I am pretty confident about the strength of the labor market.
With that in mind, as you're looking through some of the areas within this report, and we were just running through some of the sectors here, and I see here in your notes to us, specifically the general story of leisure and hospitality, of course, as we've been tracking it, it seems like there is some cyclicality that's starting to reemerge within that. What are you seeing on that front as it relates to the broader employment situation?
Right. I think we're seeing a return in leisure and hospitality, specifically this month in food and drinking services. I think that's a positive uptick. We're going to continue to see that. Another sector I tend to look at this month is government employment, specifically education employment. That's also up. So we think about those K through 12 jobs. We did see an increase for September for those as well.
Elise, when you take into account what this means then for the Fed, is it less likely that we are going to see an additional 50 basis points of cuts this before the end of the year?
I think that the Fed is going to continue lowering rates. I think that is the right move for them to be doing right now.
Why should they, if the labor market's so strong?
Well, we need to have the rates normalized. They're still very high by historical standards. When the labor market are at these kinds of levels, this kind of employment rate, this kind of wage growth, this kind of employment to population ratio, this job growth, all of those measures, when we look at it historically, the rates are just too high.
With this in mind, we had the solid reminder from our co-anchor, Julie Hyman, who hosts Market Domination. She was reminding that, of course, there's so much focus on this single print, jobs day after jobs day after jobs day. But of course, there's the larger trend that we need to think about as well. Does this at all shift, or how does this change that trend when you get a hotter than expected reading plus past revisions to the upside like this?
I mean, I think it just confirms that we're in a pretty strong labor market. I don't think it's too hot. We're not seeing, when we look at the other reports, as you point to, when you look at the job openings and labor turnover survey, right, hires are still a little bit soft. Workers, the quits rate is a little bit soft. There's not as much churn. There isn't as much flipping over of jobs and trying to get other jobs and employers scrambling. You're not seeing that kind of heat.
Elise, I know you're very focused on the healthcare sector specifically. That sector added 45,000 jobs in September, slightly below the monthly average of 57,000. I'm curious what you think that this number, what the trends, going off of Brad's question and what your answer just was, what that tells us about the strength right now of the healthcare sector.
Well, I think the healthcare sector just continues growing, right, with the aging population. I think that is very much in line with expectations.
All right. Elise Gould, Economic Policy Institute Senior Economist. Elise, thanks so much for taking the time today.
Thank you.
Let's check in on the markets, certainly reflecting a move following this jobs report here. Taking a look at the Dow, the S&P 500, and the NASDAQ. The Dow higher by a little more than 0.5%. The S&P 500, you're seeing gains there of about 0.8%. And the NASDAQ futures now higher by about 1.2%. That is a significant move since this jobs report dropped hotter than expected, and the unemployment rate, of course, ticking lower just barely, and of course coming in better than expectations. Let's take a look at Treasury yields as well, if we may. Taking a look at the 5, the 10, and the 30-year yield here, as we've got them pulled up here for you on the screen. You're seeing a move higher for the 5 by about 3.36% right now. You're also seeing the 10-year yield move higher this morning, sitting at about 3.94, and then 30-year sitting at about 4.23 right now. Move higher across the board, and then currencies, U.S. dollar, the greenback. Taking a look at the dollar, we're seeing a move higher there by about 0.5% as of right now. We've got much more coming up on payrolls when Morning Brief begins next. We're just outside of 30 minutes until the opening bell. We've got much more Yahoo Finance for you. Stick around. It's 9 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief. Let's get to the three things that you need to know today.
Stock futures are higher. Treasury yields also moving to the upside. Gold is sliding as the September jobs report data surprising big to the upside. 254,000 jobs were added to the U.S. economy last month. That was well ahead of the street's 150,000 estimate. The unemployment rate ticking lower by 0.1%. Traders are now paring back their bets of a 50 basis point cut in November.
Tens of thousands of dock workers are returning to work Friday after a 3-day strike. The International Longshoremen's Association has agreed to extend its contract with the United States Maritime Alliance until January 15th, as the two parties reach a tentative deal on wages. The final details will need to be worked out and ratified. President Biden releasing a statement of support, applauding both parties for their collective bargaining.
Brent crude oil heading for its biggest weekly gain in 2 years amid rising tensions in the Middle East. Both crude and Brent each up more than 9% this week alone. Part of the rally yesterday coming after President Biden said the U.S. is, quote, in discussions about supporting potential Israeli strikes in Iran's oil facilities. President Biden previously said that he would not support strikes on nuclear sites.
Our top story this morning, the September payrolls report coming in way hotter than expectations. 254,000 jobs added during the month of September. That's versus the estimate, that expected figure of 150,000. You also saw the unemployment rate tick lower. That coming in at 4.1% versus the expectation of 4.2%. And the average hourly earnings year over year, that came in at 4% versus the expectation of 3.8%. A lot of hot areas to really dive into over the course of this report that ultimately did move the markets higher on the back of it in this print, as we've got just about inside of 30 minutes until the start of trade. Futures reacted, sending the NASDAQ, the Dow, and the S&P 500 higher once this report crossed the wires.
Yeah, Brad, when you take a look at these numbers here, just to put it in perspective, the payroll gain was the biggest advance that we had seen since March in terms of the sectors that was leading that charge. It was leisure and healthcare. Taking a look at the unemployment rate, falling to the lowest level that we have seen in 3 months when it dropped down to 4.1%. Take a look at the market's reaction. You're seeing futures still moving here to the upside. Again, taking good news for the economy as good news here for the markets. You're looking at all three of the major averages on track to open the day in the green. If you flip it over to the bond market's reaction, you're seeing a huge move to the upside here in yield. Not necessarily a huge surprise. I was reading much of the rhetoric out there in the street ahead of this report saying that the bond market had not been pricing in the potential here for a strong beat, let alone a very strong beat. So here you are with the 10-year yield just shy of that 4% level. So, of course, any activity, further activity in the bond market, any further move to the upside, I think the question here for investors is on the flip side, at what point does that then potentially pressure equities? And then when you take a look at the moves here that we're seeing in commodities, I think that really tells you the story about how the street is looking at this report and essentially what this means for the risk of recession. You're seeing gold here move to the downside. Oil very much is moving to the upside here because of Middle East tensions. But when you take a look at gold, that's really telling the story here. That pullback in gold coming down just a little bit as investors aren't as worried maybe as they once were about the chances of a recession. Again, a very strong reading on the U.S. labor market, then reinforcing the fact that the economy is on stable footing, able to withstand maybe these higher rates. And maybe it also puts it into the fact that the Fed isn't going to be in such a rush to lower rates and lower them at consecutive meetings then before the end of the year.
Yeah, indeed.
All right, well, let's bring in Guy Berger. He's the Director of Economic Research at the Burning Glass Institute. We also have Scott Wren, a global market strategist for the Wells Fargo Investment Institute. Scott, let me start with you. When you take a look at the market's reaction here, you have equities moving to the upside. You also have yields, though, moving to the upside. I'm curious what you make of this and the fact that we could see bond yields move even higher here. At what point, then, does that put pressure on equities?
Well, Sean, I think the bottom line is good news, and that's the way the market's taking it. For us, the 10-year yield was lower than where it really needs to be. If it finished the year a bit higher than where we are now, I think that's just fine. So, the thing when I look at this report, and one of your previous guests talked about the wage gains and good productivity, which productivity is okay. But I think the Federal Reserve, if there was a kind of a stumble in this report, it's that the average hourly earnings came in at 4% year over year. I think really ideally the Fed would like to see that in the low threes. And when you combine a stronger than expected wage growth, and then, the housing, shelter, rental, the stickiness of those inflation factors, I think that tells you, and I think it tells the Fed that it's going to be tough for inflation to really crawl lower from here. And in our opinion, you're probably going to see a little bit higher inflation in 2025. So this is a good report. The market's taking it well. Stocks aren't cheap. We're looking for some sort of a pullback here, which I think is an opportunity.
Guy, I want to get your reaction to the report. I mean, it felt like once across the wires, it was kind of a spit your coffee out moment and just kind of have your eyes popping out of your head as you're looking at this hotter than expected print. What immediately went through your mind?
I thought it was great news. I think I've been mildly pessimistic, thinking we've been seeing this bit by bit deterioration in the labor market with each report, and I think there's been worry that even if we don't have a recession, unemployment is just going to be quite a bit higher by the end of the year. And I think this buys us breathing space and gives policy more time to kick in and keep the labor market in what Fed Chair Powell thinks is a good place.
Guy, when you take a look at this print, you have the jobs market holding up or very strong here from this. You also have the Fed in this rate cutting cycle now. Lots of questions about what exactly that pace is going to be. But is there anything to be too nervous about then at this point? Or does it put maybe some of those fears that you did have to rest, at least for now?
I mean, I'm still worried about the fact that hiring has come down as much as it has and has shown no signs of that descent moderating. So, it's a good job market to have a job. Your layoff rates are very low. This has been a tough job market to find a job if you need it. This allays my worries a little bit just because, again, there's more room for policy to act, which is really what we need here. There was talk a month ago of the Fed being behind the curve. They're a little less behind the curve, both because they moved in, because the labor market, judging by this report, is not deteriorating as fast as some people worried about. But there isn't, I'm a little less worried on the margin, but it's one report. If we're still here at 4.1% with three job reports down, then I'll say amazing. This was a turning point. And at that point, maybe some Scott's worries about wage growth do start coming back in the Fed and inflation start coming back in the Fed's focus. But, it's still, we're still in a place where the labor market's been cooling for quite a while and seems set to keep doing so for a little while longer, despite this report.
And so, Scott, with all of that in mind, if the Fed is a little less behind, then there might not be a need to cut as much or as aggressively out of the gate, which also means that might change what the vibes are for the neutral rate as well, which ultimately changes the investment thesis if you're looking further out. So what type of trade does a report like this initiate for investors who are trying to wrap their mind around a move that they need to make either during today's trading session or prior to the opening bell as they're charting their strategy?
Well, I think right now, Brad, it's tough, at least for us, to chase this equity market. And as I said, we're underweight long-term fixed income because we just think rates are too low and they are going to go higher. So I think right now you have to be patient. We've tried to make adjustments, whether it's the October 2023 correction that we had, or this very brief correction we had in early August, to really take money out of bonds and put it towards equities, large cap equities. I mean, I think that's what you want to try to do when you have that opportunity. And right now, if you look at some of the best performing sectors out there lately, utilities, real estate, we would be taking money out of those sectors and really rotating into the things we like industrials and materials and financials and things like that. So I think patience is very key here, which is really tough for retail investors a lot of times. But you have to be ready when you get these corrections that inevitably come. You need to be ready to pull the trigger and step in. So the outlook, if you have a 3, 4, 5+ year outlook, you need to be buying on pullbacks here, because in our opinion, you're moving towards a more modest growth, modest inflation type of an environment over time that tends to be good for stocks. We don't think we're going to see a recession. But every time when the Fed's adjusting rates, there's always uncertainty about that. We have other uncertainty going on clearly around the world, Middle East being one of them. That provides opportunity. So know what you want to buy, be ready to go, and when and if you get that opportunity, you need to be ready to step in.
You know, Guy, one of the underperforming, I guess, data points within this report that's being called out here from a couple of economists is the temporary service employment. That continues to cool. And the reason why that is significant is because it does tend to be a leading indicator for the unemployment rate. I'm curious, in terms of signs of weakness within this report, I guess, how worried would you be about a trend like that and maybe what that could portend or what that could signal here for the months to come?
That category started going down probably in certainly if not in 2023, maybe in 22. I was worried about it. The job market still kept moving along and doing okay for this entire time. So frankly, I'm not very worried. I mean, in the past, it was a leading indicator. I don't think it's a leading indicator of much, and I'm not worried about it. I mean, certainly I want every category of employment to grow because I'm a big labor market fan and want the labor market to do well, but it doesn't particularly worry me. It seems to me like there's some structural thing going on that's in the sector to get smaller.
Guy Berger, the Burning Glass Institute Director of Economic Research, and Scott Wren, of course, the Wells Fargo Institute, Investment Institute Senior Global Market Strategist. Thank you both so much for taking the time here with us today.
Thanks, guys.
Certainly. Well, tens of thousands of dock workers along the East and Gulf Coasts heading back to work today after reaching a tentative labor agreement ending a 3-day strike. Here with the details is Yahoo Finance senior reporter Danny Romero. Danny, you were out there earlier this week. You've been all across the story. So what is the big difference now? Does it seem like they've come to an agreement?
After 2 days, the strike is over. Both the International Longshoremen Association and the U.S. Maritime Alliance have come to the table with a tentative deal. They announced this just yesterday. That means dock workers went back to work yesterday, and they're on the job right now. Details were not disclosed of this tentative deal, but it was reported that both parties have come to an agreement to a 62% wage increase over the next 6 years in this new contract. Now, negotiations are far from over. The union said that they will continue to work under their current contract until January 15th. And one of their biggest sticking points has been the language around automation, which it's still unclear even if this tentative deal is in that language. Remember, the union has to approve to ratify the final contract at the end of the day.
Yeah, Danny, talk to us a little bit more about that automation factor, because yes, this does kick the can down the road for 3 months here. We do get past the election, which we know just in terms of political standpoint, that was something that seemed to be a concern here. I guess you could say almost for both sides, but especially for the Democrats ahead of this. But when you look into the impact that this could have on the sector here, if automation is in fact included, not included, the language surrounding that, what are you hearing? And I guess, what are the dock workers then still pushing for? Because that was such an important point throughout these negotiations.
I talked to one union member on the ground who brought her family there. And I thought that was a really impacting moment, because she was really trying to signal to her kids that, like, hey, this is important to be fighting for this. Really, the conversation around automation is that they don't want it at all in the contract. I talked to some crane operators. They were like, this will not help us. This will pretty much make us not have a job. But again, this is still a tentative deal. They're still in negotiation. So even if this negotiation does go through, we'll have to wait and see how that language is really specified in that contract. But at the end of the day, they are far from wanting automation completely. But we have seen other ports in Asia move towards automation, and we have seen that it is effective at the end of the day.
All right, Danny Romero, great stuff and great reporting this week on the dock worker strike. All right, we will have full coverage of the September jobs report with acting U.S. Labor Secretary Julie Su, and discuss the end of the dock worker strike with Transportation Secretary Pete Buttigieg. Plus, we count you down to the market open as stocks spike following the payrolls report. We discuss the state of the commodities market, oil heading for its best week in 2 years amid flaring tensions in the Middle East. We've got all that and more on Monday.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at Spirit Airlines, considering a bankruptcy filing. According to a report from the Wall Street Journal, the company it struggled this year following its failed merger with JetBlue. If the airline does declare bankruptcy, it won't happen right away. And this doesn't mean that they're just going to full stop, go out of business. Of course, there is an effort to reemerge from bankruptcy, but this is an acknowledgement that the company is in far more dire straits than anticipated here in the absence of this deal, of course, which was intended to create what would have been the 5th largest carrier in the United States. For Spirit Airlines, shares are reacting here pre-market down by more than 35% right now.
Yeah, and that was off the back of that massive move to the downside here following the initial report that we got from the Journal yesterday. So ultimately, what does this mean? I mean, this doesn't come necessarily, I don't think, as a huge surprise really to anyone. We know that Spirit has been trying to secure a financial lifeline really ever since the federal judge back in January at the start of the year blocked this proposed sale to JetBlue on concerns over antitrust. So we know Spirit has very much been in a dire position over the last several months trying to secure the right financing. They actually have until October 21st to reach a deal to extend or to refinance bonds due next year in 2025 in order to maintain that key partnership that we've talked about with U.S. Bank concerning its loyalty credit card. So again, lots of questions about that. And that card is part of the collateral package backing the upcoming maturities. So again, very important in this story and in context what ultimately this means for Spirit Airlines. And then I think down the road, when you just think beyond Spirit as an individual low-cost carrier, just the implications, what it means more broadly speaking for the airline space, what it means for consumers and the shift that we have seen from so many of these players with JetBlue up on your screen too, amongst them, and even Southwest, just some of the pivots that we have heard and some of the announcements, adjustments and plans here going forward and how they plan to cater maybe to a more middle income, higher income consumer going forward, trying everything they can to boost their bottom line. So we have certainly started to see this shift within the industry, and it is very competitive. It's harder for these smaller players to compete with the larger four.
Yeah, it's not easy to pivot to premium here, and we're finding that out very clearly, not just with Spirit, but also with JetBlue. JetBlue is going to be investing billions of dollars now, dollars that probably would have gone into that Spirit deal that they're now reallocating, trying to create lounges, trying to create what some of the other high-cost or high-value carriers have been able to do for years at this juncture, and trying to have a similar experience that they're able to bring to so many customers here. But it's also at the same time where there is already entrenchment for many of those carriers who have been able to deliver on-time routes and the route schedule being more favorable. But then additionally on those premium experiences, and those premium experiences, they cost money, and it's a major year, multi-year investment strategy really. And it also comes back to the aircraft. And if you've heard anything from any of the executives within the airline industry right now, there is a massive backlog. And for that backlog to ultimately be remediated, you're going to need even more production. Oh yeah, Boeing themselves, they are still navigating their own employee-employer relationship where they're trying to have a larger look at where they need to kind of combat some of the patterns of negligence in the past and have a better manufacturing future going forward that really gives confidence to the airlines that they work with. All that considered, there's a backlog in being able to deliver on some of those aircraft. So the experience is not going to change overnight, and some of these ultra low-cost carriers are not going to deliver premium in the time that they would hope.
All right, let's move on to the auto sector. We are watching European automakers today after the EU voted to impose tariffs as high as 45% on EVs made in China, lasting for 5 years. Now, this comes after an investigation found that China unfairly subsidized its industry, Beijing denying those claims. We are seeing actually a move higher in extended hours for some of these Chinese automakers. But again, ultimately what this means, I actually thought that just the conclusion and the divide that we saw within the EU over whether or not this should be imposed is worth pointing out here, because the EU is pressing on, but it is important that actually the bloc's largest economy, Germany, rejected these tariffs, and that really exposes this risk or this rift right now over the biggest trade route here with Beijing in a decade. So ultimately what this means here for so many of these companies going forward, for these Chinese automakers, whether or not prices are going to then be passed down to the consumer, how large of a price increase consumers could be facing as a result of this, and how tougher it could be for these Chinese automakers to compete within Europe, I think are big questions for investors at this point.
Yeah, just a larger part of their anti-subsidy investigation. Of course, China has been putting forward major subsidies for the vehicles that are produced within that region and sold within that region, and trying to sell them and making sure that it's also one of the stimulative efforts that's taking place within that country and within the region as well here. And the EU crackdown, they're kind of working with China, it still seems, in parallel to explore an alternative solution that would have to be fully WTO compatible here and adequate in addressing the what they call injurious subsidization established by the Commission's investigations here. Also, we got to talk about Hyundai while we're in the car space. Hyundai Motors, they are reportedly seeking a valuation of $19 billion for the IPO of its India unit. It could be the nation's biggest share sale, and it's likely to happen later on this month. Take a look at Hyundai Motor Company more broadly and what is already traded internationally here. One of the huge things that you have to think back to and consider here is for Hyundai Motor and the subsidiaries rather that they do have. They also just reported their own deliveries here, 3.7 though, decrease in their global sales from a year earlier. That was announced earlier this week. However, doing well on the luxury brand, the Genesis luxury brand, they noted maintained solid momentum, sales of about 10,638 units, so a fraction of what is produced and delivered for some of their larger brands, but still, this is a massive IPO, and we'll see exactly what the reception looks like for it in India.
Yeah, it's a massive IPO. It's one of Asia's biggest IPOs in recent years, and I think ultimately maybe what this tells us about the bet going forward on this country, on this region here for their economy, riding on the country's economic growth, foreign and local investors really putting money into this market. It's not just Hyundai, but we have seen a string of larger deals here over the last couple of years. But again, an IPO of this size getting lots of attention. The car maker may raise just over $3 billion by selling just over 17% of its India unit. We're going to pivot back to the September jobs report. The number of jobs added last month handedly beating expectations. Let's send it over now to our very own Jennifer Schomburger, who's standing by with acting U.S. Labor Secretary Julie Su. Jen.
Thanks so much, Shauna. Secretary Su, thanks so much for joining me on Jobs Friday. It's always great to have you on the program.
Always good to see you.
Very strong jobs report across the board, whether it was non-farm payrolls, average hourly earnings, the unemployment rate dropping. To what do you owe this major rebound? And frankly, isn't it an anomaly?
I mean, again, we have seen month after month for the last 4 years, really, strong economic recovery. Many people predicted this would not be possible. Right? There was no way we could come back from the economy that we inherited from the last administration, the impact of the pandemic with no national strategy in the past, and do what we've done. And I think this is leadership. It's strong economic policy. It's workers being able to exercise their power, and it's companies. Right, like helping to fuel a record recovery. 254,000 jobs created last month. The 2 months before that, there were also upward adjustments. The unemployment rate remains at or near 4% for the longest stretch since before most of us were born. And this is, again, most people thought it would not be possible, but it is. If you invest big in America, if you put working people first, and if you have solid leadership, I think that makes a really big difference.
We really saw this report bucking the trend. You mentioned the revisions upward. Typically, we've seen revisions downward on preceding reports. Again, do you think this is an anomaly? And what does this say to you about the integrity of the data on initial reading, the fact that we're seeing such volatility with the revisions?
So let's remember, right, again, the data that we report every month is the gold standard. We report the facts. Now, we also report when we get additional data. So sometimes that means a downward revision, sometimes it means an upward revision. That has always been the case for decades. This is the way that the numbers come out. The fact that they've been strong month after month, year after year under this administration makes them not an anomaly, right? I mean, this is strong, stable, steady job growth. It's the very definition of a solid recovery, and we continue to see that every single month, and we need to keep that up. We need to keep that work so that until everybody feels it, but this month it's a very good story.
Turning to the port strike, which concluded after 3 days, you were a major broker at the bargaining table. You spent the whole day yesterday in New Jersey with both parties. Walk us through what unfolded there. We know this is a deal that lasts through the middle of January. There's still lingering issues on automation. What can you fill us in when it comes to automation as well?
So this is another example of how collective bargaining works. It isn't always pretty. Sometimes, sometimes it's messy, but it is good for working people and it's good for employers, because when workers have a voice, they can help to define their working conditions. We've seen historic wage increases, not just here for the longshoremen, getting what they deserve, but we've seen it from hospitality to healthcare, from auto workers to airline flight attendants. We are seeing a moment of growing equality and equity in the workplace, where people who are profiting by the billions are understanding that they've got to do right by their workers. And I praise the companies too for coming forward with a fair offer. So that happens when there's collective bargaining, right? That's why we need good contracts, because workers get a say. And the longshoremen do a difficult and often dangerous job, and it's a good, honest living. And this initial agreement is going to help make sure that it remains a good, honest living. I'll say, just to give you a little bit of color, when this agreement was about to be reached, those longshoremen were ready to get back to work. They know the ports need to be open. They were ready to open back up last night on the night shift. We were still nailing down the details, but the ports are up and humming again, because when workers have a voice, when unions are strong, when employers come to the table with fairness, the outcomes are good for everybody.
What about the automation piece? Because that's still a lingering, outstanding concern for the union.
That's right. So that's the other great thing about collective bargaining is they will be able to talk about that, right? The parties will be able to think about what automation is going to make us more productive, what automation is going to make our ports safer.
Can you get the
right?
union on board, though, for this?
Well, the point is that they're going to be able to negotiate, right? And we saw that with the writers and the actors, right? We've seen that with hospitality and healthcare workers, people being able to have a say. It's helpful, right? This idea that somehow workers are anti-innovation is just false. I mean, they're often the most innovative because they know what's needed to improve the workplace, right? When they have a better voice in their own safety, they help make products safer. So the bargaining is what is going to, that's where that issue is going to be fleshed out between the parties, and I'm sure they're going to.
With the 62% increase in pay over the next 6 years, what's the risk of inflation making its way back into supply chain prices? Could this be inflationary?
So let me say a couple things about that. The first thing is, again, these are good, decent jobs in which people have been able to raise their families, been able to build up their communities. They also work really long hours, and so it's such an example of how the working people of this country really make everything run. These guys literally make goods move, and as a result, companies, the carriers, for example, have seen enormous profits. From 2020 to 2024, their profits have grown astronomically, and that also means much higher payments to shareholders and to CEOs. The fact that they're now going to have a share to their workers is exactly what we need to see happen. It is a false choice to say, though, then that consumers have to pay, right? Because there's so much in profit that we can have a world in which working people do well and consumers don't have to pay, don't have to pay more than they need to. And let's be clear, like, a lot of workers are the consumers, right? So what's good for working people is really good for our economy.
And before I let you go, does the union's wage increase confirm that wages are not coming back to that pre-COVID trend of 2.5%? And now that we have seen such increases in wages for unions across this country over the past year, does that spill over into the private sector? Do we see a ripple effect?
Right. I mean, a lot of these are private sector jobs where we're seeing this kind of wage growth. And you are never going to hear me say that more wages in the pockets of working families is a bad thing. And again, we are seeing that is lifting up security. It's allowing people to get a little bit more breathing room. It's allowing people to, take some time off, to feel joy, to spend time with their families, and then to retire with dignity. That's the vision of the economy that we have.
Right, we'll have to leave the conversation there, but Secretary Sue, thanks so much for your insight. Congratulations on ending the strike. Guys, I'll send it back to you in New York.
All right, Jennifer Schomburger, thank you so much. Appreciate it. Let's get on over to Yahoo Finance's Jared Blickery for a look at what is moving. We have officially begun today's trading activity. Hey, Jared.
That's right, Brad. We got some nice moves to the upside for the day, for the morning, off of that jobs report, better than expected. Nice that good news is good news. But I want to take a look at what's going on for the week. The Dow is still underwater, so it is snapping a 3-week winning streak right now, but it's only down by about 14 basis points or 0.14%. NASDAQ, it is now slightly negative, down about 9 basis points, and the S&P 500 almost break even. So we could get a change. We could extend that winning streak to 4 weeks for some or all of these indices, depending on what happens today. Russell 2000 still waiting on that to calibrate. And let's get a look at the VIX, because that has been up a couple days in a row. We're seeing it head down right now on this risk rally. It moves inversely to stock prices. So that's a good sign. It did pop above 20 the other day. That kind of raises some eyebrows, but it's not like a red warning flag, more of a yellow one. I have to look at the dollar because I've been tracking that all week long. Here's a 5-day look, and you can see it just popped to the upside. Nice little pop right there. However, that is not necessarily good for risk markets. Here is a 3-month chart, and you can see it has been up every day this week. It has now cleared decisively the 102 level, and it's been exhibiting a very similar pattern to crude oil over the last few years. And I saw this in a couple places on Twitter or X. Here is a trend channel, sideways trend channel going back a couple years for the dollar. It is just lifting off of that. Now take a look at crude oil. Very similar chart, kind of lifting off the bottom of that trend channel, although it's still negative over that time period. So that's a relationship I'm going to be watching. A higher dollar, not necessarily good for stocks, but not feeling that today. Got to take a look at, let's take a look at the sector action. We had tech leading earlier on, and that is still in the leadership position, but number 2. Consumer discretionary or retail is number 1, and then financials number 3. Those are the outperformers today, so pretty healthy mix. I'll take a look at what's happened in the week. It's been a story about energy. That gets back to those higher crude prices. But to the downside, real estate, staples, materials, consumer discretionary, and healthcare in the red for the week. Finally, I'm going to close on this. China. Look at this over the last 5 days. China's just been up astronomically, and this is the 4th week in a row. And I'll give you a 1-month trailing view, and I'll sort by performance. So you can see on this top row, we have some stocks up over 500%, 200%, all the way down to JD.com, 73%. Still quite an amazing run for a lot of these stocks. And on that note, I'll just go back to a look of what's happening today. And yesterday was a little bit of a negative day. Totally erasing that today. Guys.
You certainly are. All right, Jared, thanks so much for breaking down some of that movement that we're seeing here 5 minutes into the trading day. Keep it right here on Yahoo Finance. We've got much more of your market action ahead. You're watching Morning Brief.
The port strike is over, and that is very much good news to the country's economy. Let's welcome in Transportation Secretary Pete Buttigieg. Mr. Secretary, always nice to see you. So good news, this strike that started on Tuesday, that's done. It's over for the most part. What do you think the economic impact has been, given that it has only been going on for a short time?
Well, because it was ended in about 3 days, I think most consumers will not notice something like being unable to get goods that they were expecting. But I will say it takes more than 1 day's work to dig out the backlog from 1 day's stoppage. So over the next few days, we'll continue engaging with the supply chain players that we have always been talking to anytime there's a disruption, whether it was the Red Sea attacks or the water in the Panama Canal or the Baltimore Bridge collapse, to make sure that things are flowing well, to talk about how they're prioritizing goods. Sometimes you have something relevant to disaster relief or perishable that really needs to move ahead in line as that backlog of ships is being addressed. That'll need to work its way through the system in the next few days. But again, because it was a relatively short strike, we believe the economic impact will be manageable for the country. And meanwhile, of course, a big economic impact for the workers. They have been able to secure a raise in this provisional agreement that was reached, $24 over 6 years for a group of workers who were watching their counterparts on the West Coast get a great deal and saying, how can we participate in the profitability of shipping in recent years the way that the workers on the West Coast have. They went actually without a raise at all in some years under their last contract, just because it was negotiated in a tougher economic circumstance. And really glad to see that these workers are going to get much deserved raises.
The raises that you mentioned, Mr. Secretary, over what, 60%, 62% to be precise. Where do you expect these shippers to pass through price increases to retailers, then retailers push them through to consumers? Do you think there's an inflationary impact here?
Well, if anything, I think they're trying to catch up to wages of workers in other industries. So if you look at a 10-year period, roughly starting in 2015, you'll see the profits of the shipping companies went up by about 350%. The wages of workers around the country went up by about 42%, but the wages of these dock workers went up only about 15%. So they feel that they're playing catch up. And one of the things we've seen time and again with the historic contracts that have been reached, and I'm thinking about UAW as an example, but also railroad workers, is that you see workers getting a major raise, but one that is totally consistent with the job growth, economic growth, and profitability that we've seen, because both of those things really can and have traveled together. You add to that just the fact that the disinflation we've seen, getting inflation from about 9% back into the 2% range, a big part of that was because of improvements in our supply chain fluidity. And I think this is one more investment in keeping those supply chains moving.
I would love for you to respond to this one. So the Wall Street Journal editorial board this morning wrote a piece on the port strike, and here was their quote. They say that, quote, unions have a chokehold on commerce. We'd love to get your take on that one.
I just don't think the big problem in this country right now is workers making too much money or working conditions for workers being too good. They've made a lot of progress. But let's be very clear, and let me say, I really appreciate the companies in this negotiation stepping up to lead, bringing this to a close. Both parties really did a lot of work to meet each other in a deal space and get this done, and that's something that's especially important to our economy and something that's important in this disaster recovery context. But I just want to be clear here that all of these gains for workers have been a long time coming. They come after a decades-long stretch of widening inequality in our country. And they come at a time as these companies have become enormously profitable. So again, some commentators may grumble, but the reality is we are seeing enormous growth, enormous profits, and big wage gains for workers. Those things should travel together, and that's what we're seeing right now.
You and I have talked a lot in your current position, Mr. Secretary, about the state of the airline industry. So investors coming to Yahoo Finance this morning, they're seeing shares of Spirit Airlines down over 40% on a potential bankruptcy filing. Now, this was the low-cost operator. This was supposed to be a good thing for consumers. How concerned are you about competition if Spirit were to go away?
Well, I'm always concerned about competition in the airline sector because this is a sector that used to have dozens of players, and they were consolidated, especially over the last 15 years, to where we're really at a big four, and then some low-cost competition. So, any one company, of course, has its own issues as a business. But when I think about the industry, the sector and the industry structure, it's certainly a concern.
The regulators blocked that JetBlue transaction. Do you think that's something, some more consolidation needs to happen, given where energy prices are going? More of these airlines need to combine forces, get greater economies of scale, so we don't see something like what may end up happening with the Spirit Airlines.
Well, if an industry has gotten so consolidated that just 4 companies have the massive proportion of the business, it's hard to look at that and say, well, the problem must be that the industry is not consolidated enough, right? I'm very skeptical of the arguments that say there needs to be less competition so that we can somehow have more competition. But we're not fundamentalists about this, right? You look at the Alaska-Hawaii merger, where they were able to demonstrate a different set of merits, and were able to put forward a number of provisions that we negotiated with them on passenger protection, service protection, even making sure that the rewards program in the new merged entity didn't disadvantage people from one airline or the other, and allowed that to advance. So, we're going to, from a regulatory perspective, when these competition issues come up, we're going to keep taking them case by case and make sure we do the right thing based on our legal authorities and responsibilities. But bigger picture, this is an industry where we would like to see more competition.
Transportation Secretary Pete Buttigieg, always great to get some time with you. We'll talk to you soon. Stay safe.
Thank you.
All right, much more ahead on Yahoo Finance on the other side of the break.
Oil prices climbing today and on pace for the biggest weekly gain in about 2 years, boosted by rising tensions in the Middle East. Joining us now, we want to bring in Claudio Galimberti. He is Rystad Energy's chief economist. Claudio, it's great to have you. So we've seen this massive move to the upside here. You see Crude and Brent both pushing even further to the upside here today. I think the big question investors are asking, at least when it comes to crude, whether or not we're going to push above the $80 a barrel limit. What do you think?
Thank you for having me back. That's a distinct possibility. We are very close to that. And the tension in the Middle East is one of the highest level in 4 decades. Now, we should ask ourselves why iron price is higher to some extent, and that has to do with the fact that we have a lot of spare capacity in the Middle East. So we have come from basically 2 years of successive production cuts, and right now we have places like Saudi Arabia and UAE that sit on 4 or 5 million barrels of spare capacity. So that's keeping a lid on prices. But there is an enormous amount of production taking place in the Middle East. So if we are going into an escalation phase, and if we are going into an all-out war, then the oil markets can really be on a tailspin upwards. So $80 per barrel is definitely something we can see the next few days.
It seems like the cap to that, Claudio, would be whether or not, as part of that escalation, there was any impact to the Strait of Hormuz. What should investors be watching for there to really understand what that might do to the price action if there was any escalation that specifically impacted that strait?
Absolutely, and it's good that you raised this point because, I mean, in some cases, traders have started to buy call options at $100 per barrel strike price, which clearly shows that there is this possibility. So let me give you just a couple of important numbers. So we quoted the spare capacity in the Middle East. Let's call it more than 4 million barrels per day, between 4 and 7, depending on how you count it. Let's talk about the possible supply disruption from Iran. Iran is clearly one of the two parties in this war, and they currently export 2 million barrels per day. So if Iran was to be impacted, then this could be addressed with the spare capacity coming from Saudi Arabia and UAE. Strait of Hormuz is on a different lead. We're talking about 13 to 50 million barrels per day of oil going through the Strait of Hormuz, and this is just crude. On top of that, we will need to add LNG, we will need to add oil products. So if the Strait of Hormuz, which has been patrolled by the US Navy for the past century, was to be impacted by the war, then all bets would be off because there's nothing that can then address basically a blockage of the Strait of Hormuz. 40 million barrels per day would be akin to more than 15% of crude production. So it would be completely unprecedented.
Claudio, I know it's very, very hard to predict, especially in a situation like this, but I guess just in terms of what you're forecasting, how likely is that?
That's indeed, that's extremely difficult to predict. We definitely are not in the business of predicting anything relating to military kind of escalation. But let's put it this way, if history is any guide, then very unlikely, right? So as I said, for all the problems that we have seen in the Middle East for the past 80 years, the Strait of Hormuz has been working fine. And as I said, it's been patrolled by not just by US Navy, but primarily. Clearly, we are facing, as I said at the beginning, a situation which is we have not seen in at least 40 years, I would say, and the possibility of of a direct war between Iran and the neighbor, specifically Israel, is at this point quite likely. So that is something that the traders are now starting to price in, right? So if you see really we're currently at $78 per barrel Brent, you see call options being bought at $100 per barrel. That's clearly factoring in something of a big size, big proportion, let's call it a big supply disruption.
Which of the refinery operations are most exposed, are most vulnerable here? Thinking about Exxon and Chevron and where investors need to be monitoring the spillover effect here that could impact how they're able to move their supply around.
Excellent point, because who is present in the Middle East? Well, we're primarily obviously talking about the big NOCs, right? So the ADNOC, the Saudi Aramco, the other big NOCs in the Middle East. But if you think about the majors, actually, they have a relatively low exposure, specifically when it comes to oil. The Exxon is primarily present in the Americas, Chevron also in the Americas and in West Africa. Shell is more evenly distributed across the globe, but it only has a relatively limited exposure to the Middle East. If you think about primarily in this case, it would be Qatar and the LNG. So Total similar, probably slightly more than the American counterparts, the exposure to the Middle East. But clearly, the impact of a Middle East war would be on the Middle East producer, and the big majors have very, I wouldn't say very little exposure, but definitely they're much more exposed to other parts of the world, primarily America and West Africa. So from that standpoint, if you're an investor, purely from this standpoint, the major would stand to gain in a situation for a big supply disruption in the Middle East.
All right, Claudio Galimberti, who is the Rystad Energy chief economist. Claudio, thank you so much for taking the time here today. Appreciate it.
Thank you so much.
Certainly. Everyone, right after the break, we're taking a look at what's trending on Yahoo Finance. Stick with us. We're taking a closer look here at Yahoo Finance's trending tickers, Rivian, 7&I Holdings, and Meta. And we're doing it in 30 seconds each. Let's go. Rivian shares, they are plunging right now. This after the electric vehicle maker slashed its full year production forecast. A shortage of auto parts, slow EV demand, they are weighing on the car maker here. Taking a look at shares, they're down more than 7% as of right now, or in the ballpark of 7%. The company produced 13,157 vehicles at its manufacturing facility in Normal, Illinois, and delivered 10,018 vehicles during the same period. They did note that they're experiencing a production disruption due to a shortage of shared components on the R1 and the RCV platforms, and that supply shortage impact began in Q3 of this year. More acute in recent weeks, but it does continue, they mentioned.
All right, let's take a look at 7-Eleven parent company. Shares are surging. 7&I Holdings reportedly considering selling a stake in its supermarket business ahead of its IPO. You're looking at a jump of just about 3%. So remember, this is a company that we talked about not too long ago when there was a takeover offer that they had rejected from a Canadian rival. So here they are potentially selling off here a majority stake in supermarkets by the end of the year. This is all according to reports. Now, ultimately, we're looking at the impact on the stock price today to the upside. According to these reports, those who had a knowledge of the matter but declined to identify because of the information that has not been made public, obviously knows significant developments there. But again, an important ticker to keep an eye on here as we try to figure out what exactly this could mean for the future of the company and some of their ambition, strategic direction here going forward.
And we're also tracking Meta shares here this morning. Europe's top court ruling the tech giant must restrict the use of personal data harvested from Facebook for targeted advertising. Shares of Meta platforms right now, they're fractionally higher. They're higher by about 0.5% as of right now. The CJEU, the Court of Justice of the European Union, as they're known in their hood, more kind of looking into this and as part of the statement here, just saying that the use of data for advertising must be minimized. So far, Meta uses all personal data it's ever collected for advertising. For example, Facebook user data can go as far back as 2004 and include data entered by the user, other users, data collected. They've been so successful at this that Mark Zuckerberg is the second wealthiest person in the world as well, by the way. That's
number two, still not number one.
Well,
maybe.
Still
give
rich.
it time. Some more AI investments. All right, coming up on Catalyst, we're taking a look at the market reaction to the September jobs report. We got insight into what this print could mean for the Fed's path forward. We will be hearing from Chicago Fed President Austin Goolsbee. He joins us later next hour. I'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills, 30 minutes into the trading day. We've got three catalysts moving the markets here today. The massive beat in the September jobs print. Also, what ultimately this tells us about the strength of the consumer, and an end to Eli Lilly's weight loss drug shortage.
And we're bringing you full coverage of that September jobs report and what the data means for the Fed's path forward. We'll be speaking with Chicago Fed President Austin Goolsbee and former National Economic Council Director Gary Cohn later in the hour.
Plus, what the latest read on the labor market says about wages and the health of the consumer. We'll get C-suite insights from the CEOs of Priceline and Constellation Brands coming up.
And as Eli Lilly's weight loss drug shortage comes to an end, we look at the winners and losers in the healthcare space and what comes next for market leaders as they face heavy scrutiny over pricing.
But first, we want to start with the move that we're seeing higher on the back of the September jobs print. A massive beat out this morning. You're looking at the equity markets pushing to the upside. But I want to draw attention to the movement actually that we're seeing within the bond market, because that really tells a story that move higher in the 10-year yield. And we're seeing that aggressive repricing, I think, of traders right now in terms of their expectations of what the Fed is ultimately going to do next. So here you have the 10-year yield, the massive move to the upside here this morning, just shy of that 4% level. And if we could put the CME Fed Fund futures up on the screen too, just in terms of how traders are now expecting, or what they are expecting in terms of that next move here from the Fed. 94% are betting on a 25 basis point cut in November. That was up from the high 60s percentage yesterday. 72% expecting another 25 basis point cut in December. Again, a sharp pullback being priced into the bond market here as traders do kind of reconfigure some of those expectations moving forward.
Yeah, certainly the Treasury market getting caught off sides here heading into the print, Shauna. So I'm glad you bring that up. But I also want to pull up just the unemployment rate, reminding folks that it ticked up to 4.05%. So rounded up to 4.1% here. You can see that on your screen, but it was just above 4%, another tick lower than what we were anticipating heading into the print. So what does that tell us moving forward? Remember, the Fed is expecting 4.4% by year end in unemployment. We are far off from that. So what will that mean about the Fed's path forward here? Joining us now to discuss, we've got Leslie Falconio. She is the head of taxable fixed income strategy at UBS Global Wealth Management. Leslie, it's great to have you on here. So talk to me about the risk of reinflation here, given what we've seen in the jobs print today. Did the Fed potentially go too far too soon with 50 basis points?
I think, listen, the 50 basis point move, given how restrictive the Fed fund level is to begin with and how high the Fed fund level is, I wouldn't say they went too far. It was definitely preemptive. But I think what we've seen today in terms of the employment report and now having a 3-month average about 186,000, which is up from about the 114,000 in the last print, just reinsures the market that that 50 basis point move on the first cut is not a trend. And I think, as you mentioned earlier, and this is something that we had expected also, is the market's starting to take out those 50 basis points cuts that they had priced in, for possibly November or December. Now, as you mentioned, it's about 6% in November. It's down to about 17% in December. So I think the market is now readjusting to a less dovish outlook, which we believe they should have to begin with. So we're not surprised that they're taking those cuts out. But again, as we know, we have another employment report before the Fed meets. It's going to be very clouded given the the hurricane and some of these strikes. And you still have that divergence of what claims are showing and the employment report is showing versus things like JOLTS, where the quits rate's very low, jobs hard to find or difficult, and hiring, although there's not a lot of layoffs, there's not a lot of hiring either in the market.
Leslie, is there a scenario where the Fed stops easing given the fact that the labor market, if we do get another strong print like today's?
I find that to be very unlikely given the level of where we are. And I think that when we talk about the reacceleration of inflation, again, inflation is trending lower. We think that inflation will continue to trend lower. There's no question that you might have these pockets of vulnerability, such as what we're seeing recently in oil. But the question of sustainability and the actual impact that will have over increasing long-term inflation, we really don't think that's the case. We think that, goods inflation has obviously been coming down for quite some time. It may, if that port strike actually lasted longer, that would have been an issue, but that's been resolved. And now we think on the service side, while the service inflation has been sticky, over the long term, we do think it comes down. So you might have these pockets of vulnerability, but we don't think the Fed is going to pull back because of some large inflation reacceleration. And given the level that we're seeing of the real Fed fund rate, to continue on that cut will likely be the path. But again, it's going to be moderate. It's not going to be a consecutive of 50 basis points.
Well, let's talk about the neutral rate, because I'm interested in what we're seeing in zero coupon inflation swaps showing expectations for inflation over the next 12 months are higher than they've been since July. So I'm curious, is something like this telling us that we are underestimating strength in the economy and potentially where the neutral rate might be heading into next year?
Well, listen, finally the neutral rate has gone up. I mean, if we look at prior to the employment report in the December 2025 silver contract, you had, that contract at about a 287, which isn't far from what the Fed's projected neutral rate will be. Our expectation, we know that neutral is difficult, so you really don't know what the neutral rate is until you pass it. But our expectation of neutral was around that, still remains around that 3.25, and the market is adjusting up to that. But to your point, I mean, I think even if you look at the break-even inflation expectations of, say, 5-year tips market, 3.5 weeks ago, that was about a 187. Now we're at about a 215. So you are seeing a rise in inflation expectations, but that's twofold. One, the economy the market is removing the expectation of a hard landing, right? And it's going more to the soft landing. Two, obviously, the 50 basis point cut had the inflation vigilantes a little bit on concern. And number three, we've seen this rise in Brent and WTI, which again, we don't think is necessarily going to be a lasting tailwind to rising inflation.
All right, Leslie Falconio, always great to get your insight. Thanks so much for hopping on with us here this morning. UBS Global Wealth Management, Head of Taxable Fixed Income Strategy. Thanks so much.
Thanks.
Job growth picking up during the month of September, easing some concerns about a weakening labor market. So what does today's data signal for the strength of the consumer and the travel industry at large? We want to bring in Brent Keller. He's the CEO of Priceline. Brent, it's great to have you here. And we're starting with the jobs print and that tick up that we did see in wages, just because I would think it would be a bullish sign here for your industry, given the fact that consumers maybe do have a bit more spending power. Is that consistent with the data that you're seeing on your platform?
Well, it would certainly help. More money means more travel. The industry has held up relatively well through the summer, certainly during the peaks of summer in mid-July. As we've come into the shoulder period now, people are starting to think about holiday travel. So Thanksgiving is up next on the roster. And largely, looking at industry data for flights, they've been, largely in line with traffic last year, whereas the hotel industry a little bit stronger. So I would say that the hotel industry has normalized versus really the revenge travel cycle we saw last year, where things were really moving. But things are generally healthy right now in the industry.
I have to ask you, and forgive me, but I can't get over the jobs print from this morning, Brett. I'm a little bit of a markets nerd, as we all are over here. I'm just curious how you're thinking about hiring and the impact of rate cuts on Spirit's hiring moving forward. Did you consider hiring more off of the 50 basis point cut?
I don't think we react quite that quickly in the industry. We look at the needs of where we're moving in terms of development initiatives and how those initiatives are paying off. And so we're very careful as we move forward, but we continue to hire at Priceline. We're bringing folks on to fill especially very important roles in generative AI, where we're investing significantly, and in other tech efforts.
Right, when it comes to some of the trends that you are seeing within the industry, you mentioned the fact that you did have a strong summer that set up then going into the holiday season. I'm curious just what you're seeing spending-wise. We had the news out of Spirit today, the potential bankruptcy filing, the fact that they're reportedly considering filing for bankruptcy. Just in terms of, before we get into ultimately how that could change the landscape here for the travel industry, but have you seen a shift maybe for people maybe favoring that premium offerings that we do have?
Sure. So overall, we've seen prices largely normalize versus last year. So consumers are paying essentially about the same price for a hotel stay or an airline ticket in terms of what they paid last year. As we move into the fall, though, a few things could shift. Several of the airlines are starting to pull some of their inventory out of the market. So Spirit, obviously a big cut just announced within the last couple of days. Earlier in the quarter, United Airlines had announced that they were going to remove some capacity. So as capacity comes out, we could see prices increasing in the airline industry. On the hotel side, though, we still see new capacity coming into the market, albeit very tepid, 0.5% to 1% each quarter being added to the industry. That largely is keeping prices relatively stable, up maybe 1 or 2% year over year. So I think the dynamics are going to shift, but the airline industry clearly could see some bigger changes coming in a month or two.
Yeah, a lot of changes, including a merger between Alaska Airlines acquiring Hawaiian Air. We spoke with Secretary Pete Buttigieg earlier this morning about the aerospace in general. Let's take a listen to what he had to say.
Well, I'm always concerned about competition in the airline sector, because this is a sector that used to have dozens of players, and they were consolidated, especially over the last 15 years, to where we're really at a big four, and then some low-cost competition. So any one company, of course, has its own issues as a business. But when I think about the industry, the sector and the industry structure, it's certainly a concern.
So it's a concern from the White House's perspective. Brett, is it a concern for you?
Well, anytime you have more consolidation in an industry, that does put pressure in terms of pricing on consumers over time. I think this most recent move, a little less likely to do so. Listen, folks are trying to compete with some of the bigger players in the space, and so that helps to consolidate and to drive, more product into the industry, ideally. So we'll see how this most recent acquisition will shift things. But again, typically more partners that we can work with, the better, as we can access their pricing and inventory and share that with consumers.
Brett, as we look ahead to the next couple of quarters and then even the next couple of weeks, one of the likely themes I think that we're expecting here over this earnings season is going to be more mentions of AI, how companies are incorporating AI within their business. I know Priceline, you guys just launched a new AI travel agent. I'm curious just what you see this doing, I guess the impact that you see this having to your business, and then ultimately going back to where we started the conversation on headcount, on jobs. Does this alter future hiring plans at all?
Sure. So we believe in the travel industry, AI has a number of really powerful applications. I think one of the most obvious and where people will begin to lean in here over the next year or two is in the customer service area. We found that right out of the gate by giving people access to our AI chatbot, which we've named Penny. She can handle questions much faster than can a traditional chat agent. And she has access to a significant amount of data and information, which just makes the interaction with consumers faster and easier. Over the long run, we also see, a lot of application within the consumer's trip planning and booking experience. That technology is still quite nascent, but just this week we launched Penny Voice, which is a partnership with OpenAI, where consumers can come in and begin to engage real time by talking to the application and talking to Penny, which enables you to, again, just having more comfortable and casual conversation with access to really infinite information on trip planning and trip booking processes. So those things will shift and will aid the consumer in making reservations faster and in getting service faster on the back end when they run into challenges and issues.
And certainly making those bookings easier is important for the bottom line, I bet. Brett, thank you so much for joining us, Priceline CEO. Really appreciate it. Coming up here, we've got a conversation with Constellation Brands CEO Bill Newlands about the company's latest earnings print. Stick around for that next, right here on Catalysts.
Constellation Brands reporting mixed second quarter results with better than expected earnings, but revenue falling just short. The alcoholic beverage company seeing a 6% gain in net sales for its beer brands, but that was weighed down by a 12% decline in wine and spirits. Let's talk about the quarter. We are seeing a bit of a move to the upside here this morning with shares up just about 1%. We want to bring in Constellation Brands CEO Bill Newlands, along with Yahoo Finance's executive editor Brian Sozzi. Great to have both of you here on set. And Bill, congratulations on this most recent quarter. I want to start with maybe what was one of the focuses here of this print, and I know it came up a couple of times in the earnings call, were beer depletions, the softness maybe that we are seeing there. You gave us some sense of the macro factors, but I'm wondering if you could elaborate that on a little bit more and tell us maybe what you are seeing currently here within this quarter.
Well, fortunately, we're seeing some real change in the last few weeks. If you look at Circana IRI data, the 4 weeks is better than the 12 weeks, is better than the 26 weeks. So we're starting to see a bit of change. I think the jobs report this morning may have been a good indication that some of that concern about unemployment might be getting a bit better. Hispanic unemployment have been slightly higher, and half our business is with the Hispanic community. So we're pretty optimistic that things are going to get better.
I'm glad you mentioned the Hispanic community. 5.1% unemployment rate, higher, relatively speaking, relative to other categories. What do you see when those shoppers go to the supermarket? Are they buying less Corona? Is it Modelo? Is it across the board?
You know what tends to happen, Brian, is that people will buy what they call value packs. So if they have plenty of disposable income, they'll tend to buy 24 packs or something larger. If they're a convenience store, they'll tend to buy 24 ounce. So they look for things that have more value when there's a bit of a tightness in the unemployment area or they're concerned about money.
Is their biggest concern still inflation? Now, you've been you've told me before, you've held the line on prices a lot, but is this the consumer that is having to make tough choices when they go to these supermarkets?
To some degree. I mean, the fortunate part for us with the Hispanic customer is there's great brand loyalty, and they view beer as really a fundamental in what they do with their lifestyle. So that part's very helpful. But there's no question that if things are tight or there's concerns, that people get a little bit careful and they tend to buy more value packs.
I'm curious within the company itself, too, from an operations perspective, you talk about the unemployment report from this morning. We did see wage growth increasing, and I'm wondering, when you think about the balance sheet moving forward, revenue moving forward, is there a potential for your own employees to be maybe asking for more money and getting a little bit of the confidence we saw coming out of the pandemic, and will that potentially be a headwind?
I'm not sure that'll be a headwind. I mean, we are very careful about what we do on that side of the equation, and we treat our employees very well. And we think that's part of why we've been as successful as we are, is we have a lot of strength in our employee base. So I don't think that's going to be a big issue for us going forward.
You know, Bill, and I know I brought this up and we've talked about this in the past. It's still getting headlines, though. The shift, especially the younger consumer, Gen Z, not drinking as much or having alcoholic beverages as much as maybe some of the older generations. Is that something that you're still seeing as a potential headwind to the business? And I guess in terms of some of the efforts that you have made within this space, what does that strategy look like 5-10 years down the road?
You are seeing a little bit of change, and it's not that people are not drinking. It's that in an evening they might have a Corona, and then they might have a Corona non-alcoholic to intersperse those two. I mean, we introduced Corona non-alcoholic last year, and it was a huge success, and we're expecting that to double this year. So you are seeing some of that movement. I think the key thing that's different today than what it used to be is if you have a Corona non-alcoholic, it tastes just like Corona Extra. You know, it used to be a non-alcoholic version. Frankly, it didn't taste very good. Fortunately, that's not the case anymore. So we think that's going to continue to be an important part of what we're doing going forward.
You didn't own Zima, right? That stuff is terrible. I mean, for you
remember
kids
that.
out there, I mean,
that.
you don't even know what Zima is.
I never heard of Zima.
We're going to have to take it offline.
It's a long time ago.
It's a long time ago. Yahoo searching, folks. You hear all about just the dread that Zima. But you're at a crossroads. Do you think you're at a crossroads in your wine and spirits business? Now, several quarters of challenges. You've taken a lot of costs out of the business. But are you at the point where you have to make a decision that maybe you're going to bulk up, acquire some higher end brands, or maybe this portfolio, maybe just go really all in on beer?
Our focus right now is on improving the performance and the operating performance of the business. At the start of the year, I said it's going to take us 9 to 12 months to get this back in order, and we're 6 months into that program. We're starting to see some good green shoots. Brands like Meiomi and Kim Crawford and The Prisoner are seeing some significant improvements, and the high end of our business is doing quite nicely. The challenge has been the low end. That's been challenged for the industry overall, that below $11. So our focus at this point in time is to get that business in order and make sure that we're doing everything we can to improve the operating performance of it.
Where is a business like this in 5 years? I mean, you clearly see people gravitate towards beer, non-alcoholic options. You're seeing hard seltzers are still a thing, higher end spirits. Where is this portfolio?
I think it's a lot like what we've done with beer. All of our beer is at the higher end of the marketplace. And I think you're going to continue to see us focus more and more time and attention in our wine and spirits portfolio toward the higher end. That's where the opportunity for growth is. That's a better margin structure. And frankly, that's where the consumer's going.
I'm curious, too, about the port strike looking forward to January. It's a story that is away for now, but not away permanently. How big of a potential headwind could that be for you? And how are you strategizing around that? Are you thinking of increasing inventory already heading into the new year?
Yes, that's what we do in any situation where we anticipate those kinds of issues. We'll bring additional product into the marketplace. We would import Ruffino from Italy. We import Kim Crawford from New Zealand. We always try to get ahead of those things when we anticipate them so that they don't become short-term issues.
All right, well, really.
Wait, we're the only ones that heard of Zima? Like, I just want to rewind that for a second.
I never heard of Zima. I actually Googled it right after you said it.
Okay, I just want to
What is
go ahead,
it?
Madison.
It sounds like it's a good thing that we've never heard of it, Matt. Just judging from the two of your
Over
reactions.
to you guys. Over to you guys.
When I type it in, it
I'm
doesn't
gonna
even
stick with
auto
Kim Crawford.
All right, we'll take it offline.
Exactly. All right. Great stuff. Bill Newlands, thank you so much as always.
Thanks
I'll
for
know
having
what Zima is the next time
There
you
you
come
go.
on. I'll do my research. And of course, our thanks to our very own Brian Sozzi for bringing us the conversation. We appreciate it. Coming up here, Chicago Fed President Austin Goolsbee joining us to give us some insight on what the red-hot September jobs report could mean for the Fed's path forward. Stick around. That's next.
Welcome back to Yahoo Finance, live from the Labor Department here in Washington, D.C. on this Jobs Friday. I'm Jennifer Schonberger. For more insight on this morning's much stronger than expected jobs report and what it means for the path forward for the Federal Reserve, I want to welcome into the program Chicago Fed President Austin Goolsbee. Austin, it's great to see you. Thank you so much for joining me on this important day.
Thanks for having me back.
You have shown greater concern about the job market. We got a much stronger than expected report across the board. How are you viewing this? Do you see this as an anomaly, as a one-off, or is this a re-strengthening in the job market?
Well, I think it's a superb report to start. I always say here and everywhere else, don't get too worked up about any 1 month's report. Remember, it's plus or minus 130,000 jobs, just the margin of error. So the last 2 months when the numbers were disappointing and people began to freak out, I said, let's not overreact to 1 month's number. This is a very good number, and we got revisions on some of the previous months. If we get more jobs reports like this with the unemployment rate hopefully settling in kind of the low 4s type of range, while we're simultaneously getting inflation reads that are right at or even below the 2% target, it would give me, I can't speak for anyone else on the committee by the rules, but it would give me more comfort that we are achieving exactly where we want to be and was our goal. I've been saying the critical question, as the job market cools to a sustainable full employment level, can we stop there, or is it going to deteriorate and kind of crash through normal? The more reports like this we get, the more confident I will be that it's where we want to be.
Yeah, I'm curious whether you said one data point doesn't make a trend. We need to see more data. But does this ease your concerns that you had about the cooling job market? And at the same time, we did hear Fed Chair Powell say that the job market doesn't seem to be creating upside for inflation at this point. But given the strength that we saw, does that put inflation or re-elevate it back on par with risks to the job market in your view?
What I heard Chair Powell say at the press conference, I thought was almost exactly that there are balanced risks on both sides of the mandate now, both inflation and unemployment that we're going to look at, where for a year and a half plus, it's been almost exclusively about fighting inflation and getting inflation down. And that message that Chair Powell gave, I think is wise and exactly the way we should think about this in this circumstance. If GDP growth is coming in as strong as what some of the forecasts are saying, and if the unemployment rate and the jobs numbers keep coming in like what we saw for this 1 month, I think we would have a lot of confidence that the growth/recession risks had lessened. As long as you've got inflation numbers coming in at or below the target and inflation expectations are at 2% or even below 2%, I don't think that the risk is as high on that side of the ledger either. That would probably make you start thinking, is the productivity growth rate surge that we've seen in the last year and a half going to be more sustained? And if so, pretty much only good things come from that.
Austin, you said that rates need to come down by, quote, a lot. Given today's data, of course, depending on the path forward, the fact that you cut by 50 basis points last policy meeting, does this change the calculus for you as you look ahead for the rate cutting path?
Well, remember my statement that rates would come down a lot over the next 18 months, that we've got inflation coming in where we want it, at or around the 2% target, that we got the unemployment rate at 4.2, now 4.1%, at or around the level we think is sustainable full employment. If you could freeze the picture right there, you would put it in a frame and hang it on the wall. And that if the rates are well above what people think is neutral, where they're going to settle, then if they're that high for too long, you're going to have to start worrying about the other sides of the mandate, that you can't freeze it in that frame if you're very far above neutral. And if you look at the SEP dot plot, you see that the broad expanse of the committee believes that the ultimate settling point of rates is well below where we are right now. I don't think that calculus changes. It's still it's the through line. It's not about what's the first cut, how big is it. 25, 50, 0 of individual meetings. It's if you look at the end of 2025, do you think we're still going to be in the spot where we are now? And I think we're going to be a fair bit lower if conditions continue like this.
So then looking at the median projection based on the SEP, which guides for 2 more 25 basis point rate cuts for the remainder of this year, does that still seem reasonable to you?
You know, I don't like tying our hands or committing to specific rate changes at the next meeting or the meeting after that, because we're going to get a bunch more data before those meetings, and because I'm going to go sit down and hear what my colleagues have to say. I think our goal is to keep the conditions of the dual mandate, the inflation and the unemployment, almost exactly where they are right now. And the hardest thing that a central bank has to do is get the timing exactly right when there are moments of transition. We're in or around a moment of transition right now. We are transitioning from a almost exclusive focus on cutting the inflation rate to a more balanced approach where we're thinking about the trade-offs and keeping inflation around the target, keeping unemployment around this full employment sustainable level. And we're going to have discussions and arguments over what's the rate that we ultimately need to settle on. But I think over a 12 to 18 month period, without substantial changes to the conditions, I still see that analysis that is held by a lot of the committee, that feels right to me.
Where do you see neutral right now, Austin? And how quickly do you think that you need to get there?
Both of those are challenging and important questions, of course. I think if you just go look at the dot plot of where do people think the rates will ultimately settle down, and if you call that neutral, the bulk of the committee is, let's call it in a 2.5 to 3.5 kind of a range, and has outlined that the appropriate rate to get there is over 12 to 18 months. It completely depends on how conditions evolve, though, is what I would like to add. We can't determine the pace at which, or even the direction at which we want to get to neutral in the short run, unless we know our oil price is going to go up because of war in the Middle East. It looks now like there's not going to be a strike among the longshoremen and the dock workers, but external shocks like that have derailed many a soft landing in previous times, and we've got to be attuned to all of those conditions before we can answer that.
Well, Austin, unfortunately, we'll have to leave the conversation. There are always so many questions for you. We so appreciate you coming on today on this important day. Hope to talk to you again soon.
Great to see you, Jen. Yeah.
That's Austin Goolsbee, president of the Chicago Federal Reserve. Maddie, I'll send it back to you in New York.
Jennifer, thank you so much for bringing us that conversation. Really appreciate it. Now, coming up here, we're going to have more reaction to that September payrolls report with former National Economic Council Director Gary Cohn. Stick around for that conversation next on Catalysts.
The labor market showing signs of resiliency after the September payrolls report showing came in well above estimates at 254,000, while the unemployment ticked down slightly. Joining us now, we want to bring in Gary Cohn. He's IBM Vice Chairman and the former Director of the U.S. National Economic Council. And Gary, it's great to have you here on set with us. Let's start with that print that we got this morning. We just heard from Austin Goolsbee praising it, calling it a very, very strong print, but he was quick to point out that this is just one report. So I'm curious, what is your assessment of the U.S. economy today?
Well, I agree with that. And I always remind people when we get the jobs report, this is probably the least scientific data that the U.S. government puts out. This is actually polling data. They call people's houses. And that's how they come up with this information. And that's why we see relatively big revisions to employment data month over month. So I always say, always take these reports with a grain of salt. But the trend is important, the overall trend of what the employment report tells us. So if you sort of take the last 3 months and average them together, we're about 185,000 jobs, which is exactly about the amount of people entering the workforce. So we're at a good, really neutral place where the jobs being created and the people entering the workforce, they're balancing each other out, which is a good place to be. So we're seeing a real normalization of what I would call the U.S. economy. Everything about what we're going through, I think, is normalization. Now, in that respect, we all forgot what normal is. We have not lived in a normal economy in the last decade plus. You know, we were in a time where we had zero interest rates, where if you saw an article about the Federal Reserve, it would be, will there ever be inflation again? And we go from that zero interest rate, will there ever be inflation again, to an 8% inflation print, and we see rates going up by 500 basis points in a year. Now we're starting to get back into what is a normal economy, and I think we have to remind ourselves what a normal economy is. A normal economy with like 2% inflation, 4% unemployment, a positively shaped yield curve, all of those things that if you look at the long-term history, you would find to be the normal reality of what our economy looks like.
Well, there is some actual good news out there, right? We had inflation-adjusted wage gains about to be higher than they were for much of 2019, that era we all love to think back to. Is there a potential that this is just what a soft landing looks like?
I think this is exactly what a soft landing looks like. I think the Fed has orchestrated a soft landing. I think we will continue to see the Fed lower interest rates, although today's print gives them the ability to do what I think they were going to do anyways, which is continue to lower rates, but lower them slowly, methodically. I think we'll get another 25 basis points in the next meeting. We'll probably get 100 basis points over the course of this year. It's interesting, the market themselves.
That's more than what they said, though. They said 50 basis points of cuts this year.
I think we get another 50 this year. I think we'll get a total of 100 this year.
Okay.
We're still, that would still take us, we'd still be in sort of the 4% plus interest rates in Fed funds. Which to me is still restrictive based on where you see inflation is. We're still going to be, substantially higher than inflation, so we'll still be in a restrictive place. And I think the Fed has the ability to sort of monitor data. There's no gun to their head to do anything. And as long as this employment data stays where it is, I think this is what we'll see. I think we will see interesting reactions, and I think we've already seen this in some of the yield curves. I think that we are starting to see a re-steepening of the yield curves. 2s, 10s were inverted for a long period of time. 2s, 10s are now positively sloped. I think we're going to continue to see much more positive slope go into the yield curve. So even though the front end Fed funds, which is what the Federal Reserve controls, is going lower, I don't think the 10-year rates and the 30-year rates are going lower. And in fact, they're up dramatically today. And they've been going up even as the Fed has been talking about lowering front-end rates. So I think we're going to go back to a pretty positively shaped yield curve.
Gary, what do you think of the job that Fed Chair Powell has done so far?
So I think if you take it in its entirety, I think he's done a very good job. We can pick on pieces of what he's done. And by the way, anyone can always criticize certain segments. So, but if I look back on the entire, 7 years now, 6 plus years, he's done a very good job. I think I criticized them for being late to the inflation fight. They were thinking it was more transitory than it actually was. But once they got in the game and once they realized they had to become inflation fighters and that part of their mandate was important, they got aggressive on fighting inflation. Now that they see that inflation is renormalizing back to their target rate of 2%, which is the stable price of their mandate, they're looking at the employment picture. So, we started to see employment soften. And look, employment still is softening. There's other data than the employment report. If you look at the JOLTS data, you see that the amount of job openings has come down dramatically over the last couple of years. We're still at a high level. We're still, close to 7 million job openings in the United States, but we were well over 11, 12 million job openings at the peak of the tight job market. So I think that the Fed has done a very good job of shifting from the other side of their mandate from stable prices to full employment. And now they're in the position where they're going to balance those two things out with time on their side.
I want to switch gears a bit and talk about the election, that looming event in the air coming up.
I'm shocked that you want to talk
in November.
about it.
I know it's shocking.
You might be shocked that it took us this long to get to it.
Yes, we had to get your economic view here. But listen, we had that 82-page platform from the Harris-Walz campaign, right? Tons of credits put in there from housing to small businesses. But there are also some credits coming out from the Trump campaign as well for the economy, and the way to pay for them is through tariffs. I mean, are you concerned about, no matter who gets into the White House, there's going to be a lot of spending?
Look, I'm always concerned about deficit spending, because I think at the end of the day, we have to be cognizant of our deficit spending. The largest single item that we have being spent in the U.S. government today is deficit. We're over $3 billion a day of interest service on our debt. It's dwarfing what we're spending on the military. So you think about that. You think about the amount of money we're just spending on interest to service our debt today. It is a stifling number, and it will get bigger over time as the debt builds. We have to think about that. That's one of the reasons why I'm so convinced the yield curve is going to get steeper and steeper, is because of the amount of debt. So yes, I'm always concerned about the amount of debt that we're building up. I think it's very important, and I think both candidates need to understand, and I think some of them do, is that we need to grow the economy. The only way to really deal with the debt problem is to grow the economy. Our debt as a percentage of GDP can go down if our GDP goes up. To me, that is the essential ingredient, is do economic growth. I don't believe we should be in an economy where it's based on a plan of redistribution. I think we should be in an economy where we're based on a plan of economic growth. And we want to provide a system of rules and regulations and regulatory environment where we're encouraging growth, not discouraging growth.
So then, Gary, given what we know, I'm not asking who, just ultimately, just from what we do know right now, from the facts that have been laid out, is one candidate better than the other for the economy, or is it more of, is there too much uncertainty that still remains?
Well, here's what I think we do know for sure, because as you said, there's an 82-page economic plan from the Harris-Walz campaign. There's a lot of rhetoric from the Trump, J.D. Vance campaign. I think what we know for sure, and this is how I evaluate, we know what the economy looked like for the 4 years of the Trump presidency. We know what's happened in the Harris-Biden presidency. We know what those two economic pictures look like. I think you've got a lot of data to make a decision what economy you like. Now, I'll be honest, I happen to like the pro-growth, the reasonable but sensible regulatory economy that we had during the Trump administration. I think this overly protective, overly restrictive, highly regulatory economy that the Biden-Harris administration has is not beneficial to growing GDP, especially when you keep losing cases in court where you're trying to restrict the economy and your restrictions don't even hold up in court.
Gary, real quick before we let you go, let's talk about the corporate tax rate, right? Sure. And that's one of the things that's being debated. We have 28% on the talk of the Harris campaign, all the way down 15% from Trump. I'm curious, just in your role at IBM, if we do see 28%, what does that mean for larger corporations?
It's bad.
How bad?
It's bad. So look, when we rewrote the tax code, one of the most important things I thought we had to accomplish was that we had to make ourselves competitive with the rest of the globe. Corporations compete around the world. There's many U.S. companies that sell vastly more products overseas than they do in the United States. There's many companies prior to the U.S. tax rate going down to 21% that had the option to re-domicile into another country to to avoid paying U.S. taxes. They were inverting their businesses out. It was a horrible thing for the United States to see companies that wanted to be based in the United States leaving the United States for one reason only, to lower their corporate tax rate. We have not had a company leave the United States since the corporate tax rate's down to 21. The OECD average, which is the countries that we care about, the average tax rate on the corporate side is right there in the low 20s. It's 21, 22. It's right in that area. That's where the sweet spot is. We do not want to discourage companies from being based in the United States and paying taxes in the United States. We also, in that tax change, forced companies to pay U.S. tax for offshore earnings. And we forced them to bring back, we didn't force them, but we encouraged them to bring back offshore earnings. I think the encouragement, and we encourage them by deeming a tax on their offshore earnings. By deeming that tax, an enormous amount of money came back in the United States. Hundreds of billions of dollars came back in the United States. And that money is being reinvested in the United States. And that's one of the basic reasons I think our economy is so strong. I think a lot of people have missed that point.
All right, Gary Cohn, we got to leave it there, but really appreciate you making the time for us. Thank you so much. Again, IBM Vice Chairman Gary Cohn joining us here in studio.
Thanks for having me.
Thanks, Gary.
Well, coming up, we're taking a look at Yahoo Finance's trending tickers. Stick around for us for more right here after the break.
Now time for some of today's trending tickers. Scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Cisco. Cisco has reportedly agreed to invest in AI startup CoreWeave, valuing the company at $23 billion, according to a Bloomberg report. Now, CoreWeave already has some big name investors like NVIDIA, Fidelity, and Jane Street. You are looking at the move higher in Cisco Systems today, up just about 0.3%. But I think the big takeaway here for investors is ultimately, Maddie, what this tells us about the future of AI, the interest that we're seeing from these larger tech giants, those that already have a footprint and exposure to the AI space, just how much they are willing to spend, how much capex they are planning to allocate towards AI investments going forward, and ultimately the impact they see AI having on their business here from here on out.
Especially a company like CoreWeave that has had touch points with the likes of NVIDIA, right? NVIDIA is one of the early adopters, or CoreWeave rather was one of the early adopters for NVIDIA's graphics processing units, and they are using those to build out their own data centers here. So certainly something we'll continue to monitor amid that AI boom. But we want to get to shares of Spirit Airlines plummeting as the low-cost carrier's efforts to avoid bankruptcy are in jeopardy. That's according to a report from Bloomberg. Now, Spirit's seeking new financing, looking to extend its current debt. Without a deal, the company could be forced to file bankruptcy. The Wall Street Journal reporting Thursday that Spirit has held bankruptcy discussions with bondholders. All of this coming after a failed attempt to merge with JetBlue earlier this year. You can see that Spirit down 22% right now. Earlier today it was down 30%, and this comes on the heels of a lot of pressure we've seen across the airline stocks over the last week here. We've seen some of these names on your screen moving to the upside off of the Spirit's news, perhaps, but earlier this week under pressure, and my interpretation of that was that it was due to some of the extension to the upside that we saw in energy stocks. So it'll be interesting to see how this plays out moving forward here.
Yeah, especially when you take into account the 17% move higher here from JetBlue today. Yeah. All right, let's take a look at the healthcare space. Healthcare jobs growing last month, the sector adding 45,000 jobs in the month of September. To break it all down and what this means for the industry, we have the best person to ask in the newsroom, Yahoo Finance's very own Anjali Kamlani. Hey, Anj.
Hey, Shauna, that's right. This month was really interesting when it came to the jobs report because we did see a little bit slower growth in the sector than we have been seeing in the past few years. But one thing that I thought was an interesting number was the blowout from the home health care. And that breakout is interesting to me because we've seen over time that breakout hasn't been consistent. And it tells me that with ambulatory not necessarily being a key focus anymore, it's shifting to home health care. And that's important to watch in the next few years. We've talked about the aging population and how that's going to be impacted. So that's a key one to watch.
And Eli Lilly's Mounjaro and Zepbound were removed from that FDA shortage list. I'm curious from your perspective what that means for Eli Lilly moving forward here, and also then what it means for some of the competitors in this space like Hims and Hers, which was down, I think, 30% yesterday.
Yeah, interesting that they were, because they are actually not providing tirzepatide. They're actually providing Novo Nordisk semaglutide. So what's interesting is the compounding pharmacies and the compounding manufacturers are going to be really hitting up a countdown clock now, which is a sort of weaning off of when they're allowed to provide the copycat versions of Zepbound and Mounjaro. So that's one thing to watch as a result of this news. And it's important to point out that this is actually follow-up to Eli Lilly notifying the FDA back in August that they were starting to produce more of the drugs and they should be getting off the supply shortage. But it is important to note that the metric used for that is unclear. So whether or not what that means of sort of meeting current demand, there are still going to be some patients who may not be able to immediately access it, but it does put Lilly in a much better place than competitor Novo Nordisk, because we've seen in the weekly prescriptions that are filled that Lilly is sort of edging ahead in both those categories of type 2 diabetes and weight loss. So it's going to be interesting for Novo to see how they catch up now that they're still on the shortage list.
Pressure's on. All right, Anj, thanks so much.
Well, coming up next hour, we've got Wealth. It's dedicated to all your personal finance needs. Brad Smith will have you here for the next hour, so stay tuned. Have a great weekend.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, we're diving into the all-important September jobs report. We discuss the health of the labor market and zero in on workers with side gigs. And some bad news for home buyers. Mortgage rates ticked up slightly this week. According to Freddie Mac, the increase due to a mix of escalating geopolitical tensions and a rebound in short-term rates. We'll discuss what's ahead with Realtor.com's chief economist. Plus, it's officially spooky season, and we're diving into what consumers expect to spend on Halloween and when the best time to purchase those bags of candy actually is. All that and much more. But first, let's take a look at some of the market action 90 minutes into the trading day here. Stocks right now still in the green for the U.S. major averages, the Dow, the S&P 500, and the NASDAQ, all in positive territory, but giving up some of those earlier gains that we had seen. So off of some of the session highs from the hot September jobs report. Joining me now, we've got Ruben Hovhannissian, who is the TCW Fixed Income Generalist Portfolio Manager. Great to have you here with us today, Ruben. So first and foremost, just gotta get your reaction to that much hotter than expected jobs print and what that signals for portfolio strategy as well right now.
Good morning. Thank you for having me on. Well, it was generally speaking, a fairly strong report on multiple fronts. Although, if you wanted to pick a weak data point, you could look at average weekly hours, which declined. Aggregate hours also ticked down slightly. Or you could look at temporary help employment, which is often viewed as a leading indicator, and that continued to decline. But generally speaking, again, strong report. That being said, it's just one data point, and it's important data point, should not be ignored, should be incorporated into analysis. That being said, we should recognize that this is a series that has been very volatile, subject to seasonal adjustments and many other adjustments in the past. Let's not forget that a month ago, we learned that a non-farm payroll creation over 1 year period was revised down by about 30%. So while should not be ignored, it should also be taken with a grain of salt or a fistful of salt. And more importantly, it should also be put in the context of overall labor market indicators. And I think when you look at the bigger picture, global market labor market indicators, broader labor market indicators, you see, they paint a picture of certainly a weak and weakening labor market. Will you look at hiring rate? JOLTS report came out earlier this month, and it's, hiring rate is at 3.3%. You really have to go back to 2013 to see those levels. Quits rate is low and declining. You look at ISM manufacturing employment rate, again, levels that go back to probably 2008 to see those labels. And also, if you look at the surveys of what the consumers or what the population is saying about labor market, the labor market differential indicator, which takes the difference between those who say labor jobs are plentiful and those who are saying jobs are hard to find, this is continuing to go down, which means that people are having a hard time finding jobs.
Ruben, as we've been discussing it throughout the morning, many of our guests pointing out that this might change what the neutral rate for the FOMC starts to look like, which thus does initiate at least a little bit of a duration-focused investment portfolio shift here. As you're looking at it and evaluating it on the fixed income side, what type of duration shift might that initiate?
Well, we don't think that 1 month unemployment report should change where the neutral rate is. The neutral rate is impacted by many factors. Most of them are, most of them are secular in nature. They're based on long-term trends. So 1 month report may not. That being said, we do see repricing in the rates market. So the investors seem to, believe that this economy is growing stronger, and that may require less rate reduction. If you look at the rates market today, speaking of rates and duration, as of yesterday, the market was pricing closer to 3 cuts this year, 70 basis points of cuts this year. Now they're pricing closer to 55, 60 basis points, which is closer to 2 cuts.
Right.
The number of cuts next year has come down as well. So the front end of the yield curve is higher, generally speaking, which seems to suggest the market is taking it as a indication of stronger economy and the yields that will be higher than the market thought yesterday.
Right, and I certainly do agree. We don't want to just zero in on one month, but when you have a report like this plus revisions for previous months, that's where it starts to change that trend a little bit more. And so if you're looking out into the future, and for a lot of investors that have tried to make sure that their portfolio strategy is not fighting the Fed, but anticipating perhaps what their policy pathway may look like in the amount of cuts or the depth of cuts that are anticipated even into the end of the year and even into next year, where, as you look out into 2025, does that kind of set up your own strategy and how investors should be positioning themselves?
Sure. So we think that we've thought and continue to think that the economy is continuing to decelerate, and that deceleration will become more pronounced, towards the end of the year and early 2026. With that in mind, we think that the Fed at some point will have to actually accelerate cuts, which is not something that the market is telling you today. But we think the Fed will probably have to accelerate cuts, because let's not forget that even after 50 basis point cuts, we're still in a fairly restrictive territory. So even if you think that the economy is not slowing, even if you think it's at full employment and it's not overheating, it's not slowing, the Fed rate should be closer to neutral territory, and that neutral territory, regardless how you measure it, is at least 200 basis points lower from here. So we think that the Fed will have to accelerate cuts. We think that what's being priced in, which is 25 basis point incremental cuts over the next year and a half, is not going to be sufficient to stimulate the economy sufficiently to forestall the slowing economic growth. We think there is a little bit of inconsistency between where the economy is and where the rates are, which is still at a fairly restrictive territory, about 200 basis points at least higher compared to where the neutral should be. So we are overweight. We do think that it warrants to be overweight at this point, especially in the front of the curve. The 2 years and 5 years, which will benefit more from faster rate cuts than what's being priced in.
Ruben, thanks so much for taking the time here with us today. Ruben Hovannessian, who is the TCW Fixed Income Generalist Portfolio Manager. Have a great weekend.
Thanks, Brad. Always a pleasure.
Certainly. Attention taxpayers, the IRS's free direct filing is expanding to a dozen new states and covering a wider range of tax situations starting in the 2025 filing season. So if you're in Alaska, Connecticut, New Jersey, New Mexico, or any of the other 19 states you see on your screen, next year you can file from your cell phone, laptop, tablet, desktop, all for free. Now, if you live in any of the other 26 states, don't worry, there's still time for your state to join the direct file system before next year. The IRS is making other changes as well. They're adding to the ability to handle different tax situations in 2025 that it couldn't support last year. Things like 1099s for interest income greater than $1,500, retirement income, deductions for health savings accounts, child and dependent care credits as well, plus retirement savings contribution credits, and many more. The IRS saying it will continue to gradually expand direct file scope over the years to support the most common tax situations, particularly those impacting working families. Last year, 140,000 taxpayers across 12 states used direct file. In January, when filing season begins, over 30 million people in 24 states, they will have access. Well, switching gears here and turning back to the labor market, over 1/3 of Americans have a side hustle, according to a Bankrate survey. And 72% of people say they feel more financially secure with more than one source of income, according to a recent Quicken survey. To discuss how a side hustle might get you closer to your wealth goals, we have Eric Dunn, Quicken CEO, personal finance software provider. Eric, great to have you here with us today. Certainly do appreciate the time here. So, just walk us through what you're finding in the survey here and the number of people that are feeling that they need to have that side hustle in order to complement their prime gig or their main gig.
First, thank you for having me on today, Brent. It's great to be here. And I guess I personally found the results of our recent survey a little bit surprising. We surveyed 1,000 adults who have a side hustle, which we define as someone who they have a regular job, but they also have another source of income from their independent activity. And maybe I have kind of an old-fashioned view of what a second job would be, and sort of imagining exhausted factory workers taking in laundry in the evening to buy shoes for their kids or people working in a remote call center. That is not what these people are doing. If you look at what the side hustles are reported in our survey, the number one activity was personal assistance. And historically, that was something you had to do in person, but technology has enabled, a lot of remote activities. Caregiving is also on the list, animal care, fitness, writing, and then one of my favorites, crafts, people, sewing or cabinet making, doing things that are kind of creative and high value and often things they really like. And that was kind of the overall sense I took away from the survey, is that a side hustle is not a stopgap, a desperation measure to make ends meet. It's a positive in these people's lives. They figured out a way to fit the side hustle into their other working life, and it's not a stressor. It's not a stressor because for them it's an efficient way to make extra money, and they're typically making over $1,000 a month, so it can be material to a lot of families. And in many cases, it's aligned with their passion, and it's fun. Now, don't get me wrong. There are some, hardworking families where the side hustle is essential. Mm-hmm. They need that to make the budget balance for their family. But in the majority of cases, they're using the income from the side hustle to do something positive in their financial life.
Certainly.
In many cases, they're paying down student debt. It's funding leisure activities, or sometimes they're saving. So just in summary, the modern side hustle fits into people's lives pretty well. It's a positive in their life, and for the most part, it works really well.
And so with that in mind, and the number of people that are trying to balance side hustles, how can those who don't currently have a side hustle but are trying to figure out where to create additional income? Because we always talk on this show about creating streams of income, and a side hustle may very well be one of those. What's the best way that you're finding people are effectively going about balancing side hustles right now?
Yeah, I think a couple of things stood out with people who successfully worked a side hustle into their personal and financial lives. One is to start slow, and there's clearly a risk of overcommitting and creating stress. The other is, if you possibly can, find something that kind of matches your passion, something that you enjoy doing, something that's a positive in your life. And then another hallmark of the individuals who are successful is they dealt with what we see as one of the one downside of having, or the one significant downside of having a side hustle, which is managing a little bit more financial complexity. If you just have a single day job, understanding your income is pretty easy. It's predictable. Every 2 weeks you get a paycheck. If you have a side hustle, the income is much more unpredictable. And also any expenses associated with it need to be tracked separately. So for people who haven't found a solution for tracking this extra financial complexity, it can be a source of stress. Many of the people who are struggling with the complexity resort to spreadsheets,
right,
or in some cases using multiple apps. And then, of course, the happy path, of course, is they use a product like our Quicken Simplify or Quicken Classic, which is a great tool for people in the situation to manage the additional financial complexity. So to recap, how do you get into it? Start slow, pick something that aligns with your passion, and get started early with the right financial tools so that you don't end up juggling the math as well as the time.
Eric, just lastly, while we have you here, we know the business that Quicken is in. We know that there's this new IRS free tax filing that's expanding even further to 24 states. I wanted to get your thoughts on this and if there's any impact materially to your business.
Yeah, thank you for asking that. 140,000 tax filings is not a huge number in a country that has well over 100 million tax filings, but presumably it will grow and become significant over time. Our business isn't about tax preparation. Our business is about helping families track their finances and assemble the information, including the tax-related information that they use when they file their taxes. And whether they file their taxes using the IRS direct file program or with an accountant or using a software product, they still need to assemble the information in a coherent, accurate way, and we help them do it. So it's a neutral for our business, and I think our value proposition for people filing taxes remains strong.
Eric Dunn, Quicken CEO. Eric, great to speak with you here today, and some great insights from the survey findings as well. Appreciate it.
Okay, thank you again for having me on.
Certainly. Well, fourth quarter earnings season is about to kick off in earnest. Here with what you need to know about what company earnings are and why they matter. We've got Catalyst co-anchor Maddie Mills. Hey, Madison.
Hey, Brad, thanks so much. So think of it as a quarterly report card for public companies. Every 3 months, these companies are required to publicly disclose their finances. Now, earnings often contain some executive commentary, forecasts moving forward, or statements on just the general macro environment. So we're going to run through 4 things investors need to watch out for and why they matter for every earnings report. I want to kick it off with the earnings themselves, right? Also known as profit or the bottom line. This is the amount of money the company earns after their expenses. And it's often calculated as something we call EPS, which stands for earnings per share. That tells you the amount of profit per share of the company's stock. Another thing you want to watch out for is revenue. That's also known as the top line. Revenue is the total money generated from business operations. It's all of that money coming in before expenses are even deducted. Now, moving forward here, you also want to monitor guidance. Sometimes companies will report to you how they think they're going to do in the future in the form of guidance. And this can vary, right? Companies can provide this for the next quarter, the next year. The guidance could also be about revenue, sales, earnings, really whatever they want. And that's a key indicator of the company's health moving forward. So now that we know the basics here, let's talk about how earnings are evaluated. One really key thing to monitor heading into earnings prints: analyst expectations. These are those individuals who monitor company performance. They're paid to do that throughout the quarter, and they publish calls on what they expect company earnings to look like. And you can compare the actual results from these companies to those analyst expectations for a sense of how well that company did. A company can beat on one part of the earnings print, like revenue, but then miss on another metric like profit, and that could lead to what we call a mixed earnings print. Now, guidance is really critical here. Even if company guidance is positive, if it comes in below the street's expectations, you could see pressure on the stock following the earnings release. Nearly every company will hold a conference call after releasing their earnings report. Wall Street analysts are usually the ones asking questions to executives about the quarter and outlook. Now, those calls typically add more color to the last quarter, the industry environment, and what's coming up next for the company. Ultimately, those reports are important for you and your money because they determine how the company is doing and where it could be going, Brad.
All right. Thanks so much, Maddie. A lot to keep tabs on once we begin this earnings season. Appreciate it. Guys, coming up, mortgage rates actually ticked higher this week. We're going to bring you the numbers and talk about where rates are headed through the end of the year to the best extent that we could read into that crystal ball here. We've got much more in that discussion after the break. Some not so great news for home buyers. Mortgage rates actually rose slightly this week, mirroring a jump in Treasury yields that serve as a benchmark. Here to explain, we've got Yahoo Finance senior reporter Claire Boston. Claire, why? Why'd you do it?
I'm sorry, bad news for potential homebuyers here, but what we are seeing is basically a very slight uptick in mortgage rates, mostly due to the fact that treasuries also rose this week. Mortgages are very, very correlated with those government bonds. What is interesting is that from here, we have to kind of see it's going to be all about economic expectations. Basically, any case for the Fed to cut more would be supportive of mortgage rates, but that's not what we're seeing today. We had that really, really strong jobs print. And that means that any further Fed cuts we get will be smaller. And that means, rate expectations to fall from here, not so clear.
So let's go further into that. Today's jobs report, does it mean anything in a direct pass-through or transitive property for mortgage rates here?
A little bit. So we saw after the jobs report, a lot of front-end yields really rose. Generally speaking, we think that there's going to be smaller Fed cuts as opposed to bigger ones this year. That would all mean that mortgage rates might even go a little bit higher from here, which is a little bit odd, but it just shows that relationship between mortgage rates and bonds.
That's really interesting. What does that tell us about how much was already priced in to mortgage rates in anticipation of what the Fed activity might look like?
Right. It really means that, maybe even too much was priced in. Maybe mortgage rates went lower expecting that the Fed was going to cut bigger or faster than they will likely do now based on the economic data.
Yahoo Finance's own Claire Boston. Thanks so much, Claire. Appreciate it.
Thank you.
Great breakdown. Sticking with housing here, Realtor.com is out with its monthly housing report, and it reveals home sellers increased listing activity in September, with 11.6% more homes listed compared to last year. That's a 3-year high and comes as mortgage rates have generally been on the decline and following the Fed's big 50 basis point cut. Here with more insights, we've got Danielle Hale, who is the chief economist at Realtor.com. Danielle, always a pleasure to grab some time and get some of these insights here. So break down the findings here among listings, and are we seeing any improvement on the listings that are on the market, getting bids, and for how long they're staying on the market too?
Yes, there's a lot of momentum in September. The focus in our report this month was on those new sellers. So we call them new listings. Those are sellers that decided to put their home on the market in September. They were up 11.6% compared to a year ago, which is a nice improvement because in August, we actually saw that number tick down slightly. So more homeowners are deciding that now is the time to sell relative to 1 year ago. It's important to note that in September, we typically see the market slow down. So this is still a slower period. But despite that seasonal shift, we are seeing more homeowner sellers get into the market. So that's a good thing for buyers. Even though we saw more sellers, we saw homes take a little bit longer to sell. In fact, a week longer compared to 1 year ago, which makes this September the slowest September that we've seen in 5 years. So buyers have more time to make decisions in the housing market right now. This adds to their advantages because fall is typically a slower period. It's often what we call the best time to buy in the housing market. And so buyers have a lot of advantages seasonally and some even greater advantages thanks to the shifting market momentum.
Slowest September in 5 years, Danielle. What does that signal for, or what's that done ultimately for the housing prices, home prices during the month?
Yeah, interestingly, even though the market has slowed, we haven't seen prices relent much. At the median level for listing prices, we saw a drop of 1% compared to a year ago. It's very, very modest. And if we take a closer look at that median price and break it down by square foot, we can see that we actually had more smaller homes hit the market, which helped bring that overall median down. On a price per square foot basis, home prices actually ticked up, which might explain why if shoppers are looking in the market, they don't feel like homes are actually getting less expensive. If they're looking at a similar sized house, it actually did get more expensive in September, even though the overall median went down. The fact that the overall median went down tells us there's more smaller homes on the market. So if you've been looking for an entry-level home, you're likely to find a bit more of them on the market now. So that could be a good sign, but it's not likely to be much less expensive.
When we were just discussing with our senior reporter, Claire Boston, about mortgage rates and ticking higher just a little bit, do you expect mortgage rates to continue to tick higher, especially as we've been watching for the markets and the digestion of where economic data is moving and suggesting that the Fed might not be as far behind the curve as thought previously or as feared previously, which means we might see less deep cuts in the future as well.
Yeah, that's certainly possible. When the Fed made their projections in September at their meeting, they were anticipating 50 basis points in additional cuts between September and the end of the year. They have two meetings. That's a 25 basis point cut roughly each meeting. The market, however, was anticipating 75 basis points of cuts. There is a gap between those two projections. Somebody's going to be right. Somebody's not going to be right. And based on the jobs data that we saw today, it's looking like maybe the Fed's projection is going to be right. So I expect we're going to see the market shift and try to squeeze out some of those cuts that had been anticipated. And we may see mortgage rates tick up a little bit higher. But taking a step back and looking at the big picture, even though mortgage rates did tick up, they're only a few basis points above the lowest levels in 2 years. So they are still in a very favorable position. And if we look at this week's mortgage application data, we saw that purchase mortgage applications actually ticked up for the second week in a row compared to a year ago. And that's the first uptick that we've seen in that data in 3.5 years. So I think even though mortgage rates ticked up a little bit, they're in a better position than they have been, and buyers are starting to react to that information.
Danielle Hale, who is the Realtor.com chief economist. Danielle, thanks so much for taking the time here today.
My pleasure.
Well, the light at the end of the tunnel is coming for the home improvement sector here. A soft housing market has weighed on retailers like Lowe's and Home Depot over the past couple of years. But a turnaround is within sight as the Fed finally enacted a large rate cut this month. So here with more and the story, we've got Yahoo Finance housing reporter Danny Romero and senior reporter Brooke DePalma. Got to correct myself, of course, that cut was during September. We're now in October. We've officially begun Q4 of this year, which means, hey, in just a few weeks, we'll be hearing from some of these retailers. So, Danny, let's start with you. Tell us about the state of the housing market and how we got here.
Buyers and sellers were looking out for one thing, lower rates. And now they have it. Mortgage rates hit a 2-year low and are more than a percentage point lower since May. And let's put this into context. Over the past few years, homeowners have been dealing with high home prices and as well as high interest rates, which is one of the reasons why people kind of put off remodeling or renovating their home. But sales activity remains very weak. The National Association of Realtors reported that the existing home sales hit a 10-year low in August. Economists at Wells Fargo tell me, though, that now that lower rates are in the picture right now, that could bring more people back into the market, selling their home, also more appetite for housing in general. Economists at Wells Fargo also estimate that total existing home sales will reach a 4.13 million annualized rate at the end of the year and a 4.37 million annualized rate next year. But people are still waiting for lower rates. One real estate agent put it this way: buyers are hovering the housing market right now.
Wow. All right. So, Brooke, what could retailers see ultimately within all of this? And could they be the first to see a benefit from this as well?
Yeah, a retailer, home improvement retailers, it is like Floor & Decor, Home Depot, and Lowe's have really been waiting for this turnaround in the housing market. And in the past month, we've seen investors become optimistic about this potential turnaround. Now, it's interesting to note that in the short term, Floor & Decor might actually benefit the most. And get this, Brad, the reason why is because people actually redo their floors 6 months before, and then once you buy the house 6 months after, which I was surprised to hear from the analysts at Bank of America. So Floor & Decor positioned to benefit first, but there could be a drag on short-term demand when it comes to Home Depot and Lowe's. And it has to do with a lot of what Danny was saying. People are hovering the house market. They're not necessarily jumping in, perhaps waiting for further rate cuts. Lowe's and Home Depot, we know that they both provided softer same-store sales guidance. That's after ongoing declining same-store sales growth from both retailers in the latest quarter. But one analyst expecting that sales growth will be roughly flat to slightly up in 2025. Of course, keep in mind, Lowe's has more of that DIY customer, Home Depot more of that pro customer.
All right, we'll see if the worst is behind both of these retailers here. Brooke and Danny, thanks so much for breaking this down. Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance. The latest jobs data shows the labor market remains extremely strong, but many companies have slowed hiring from the post-pandemic highs. Still, there are ways to find job opportunities even as the job market begins to moderate here. Joining me now, we've got Shirley Davis. Shirley is the president of SDS Global Enterprises. She built a successful 30-plus year career in human resources. Great to have you here with us in studio.
It's my pleasure. Thank you for having me.
Absolutely. So let's talk about this a little bit, especially as we think about the report that came out this morning. Yeah. Still seems like there are some, for better use of a phrase, hot pockets right now in the employment landscape, but there are some areas of moderation. How can employees make sure that they're doing their due diligence in their transition into new roles and ultimately identifying those positions that are open to move into as well?
Yeah, you got to leverage your network. I think that's very important. I know online there's so many opportunities there. If you're using AI, you can certainly use that for example, LinkedIn and Indeed and all of the other talent sources that are available online. But that network is key and critical because they can help you be referred to jobs that are available, tell you a little bit about the culture that's there, tell you what kind of skills are necessary in order to be able to really look at the job as an opportunity for you to grow and to thrive. I like to use AI because I think it's a great tool to use for how do we, for example, I'm thinking about job searching, skill matching, or if I'm looking to get learning and development. LinkedIn Learning is a great one to leverage. Coursera is one, and certainly I've used all of those, and I'm so really proud to be a LinkedIn Learning author where we also help people with the job skills that they need to really upskill and reskill.
You hear so much about upskilling, reskilling right now, and it's because there are a lot of people that are trying to chart their pivot.
That's right.
What are the best ways to essentially chart that pivot ahead of time before you even get into the interviewing process and then taking on a new position?
Yeah, I think you definitely have to do your due diligence and look at what are some of the kinds of skills, competencies that are necessary. There's a lot of opportunities to find online. For example, Glassdoor.com, Salary.com will tell you a little bit more about the kinds of roles are available, the skills that are there, and the salary range. And then knowing that you align. Be clear about what are the skills, gifts, talents, and strengths, as well as the results and the value that you bring to the organization. And do the due diligence on salary. What is the salary range that you feel like all of those skills that you bring really justify a salary range? And I say do it with clarity, do it with conviction, and do it with confidence.
I like a phrase that you have. You talk about golden handcuffs. Explain what those are and how job seekers can break out of those golden handcuffs to find some new opportunities.
Yeah, important to think about golden handcuffs, which really is a very lucrative or sometimes an appealing package that they offer you to stay on board or stay for a longer period of time. That has some advantages, but it may have some disadvantages as well, particularly for people of color, especially because we don't always see representation at the top. We don't always see pay equity as we should, and we certainly don't see the role opportunities for growth and promotions. And so the golden handcuffs, while they give you great bonuses and financial perks, they can also handcuff you to a degree to where you need to make sure you're aligned. Is this where you want to be in a year from now, 2 years from now? And you may even be able to negotiate that contract for a shorter period of time. But know that if you're going to have a golden handcuff approach, that you need to make sure that it is aligned with where you want to be long term.
What are the new age negotiation skills that everyone needs to remember as they are negotiating compensation packages and salaries?
Well, do your homework, know your value, but not only your value with the skills that you bring, but know the value based on the market. What is the market holding? What is the salary range that's out there? And then what are some of the results and the achievements that you have achieved that you can then offer to the company? I think that's a big part. I'm big on asking people who've already worked on the inside of the organization, what might be a great way to do that. And then using talent search firms is another great way to find out what is the salary range and how I can negotiate that.
Shirley Davis of SDS Global Enterprises. Thank you so much for joining us here in studio.
What a pleasure. Thank you.
Thank you. Switching gears here, everyone, finance, of course, is a deeply personal matter here. And for the LGBTQ plus community, this personal aspect is often amplified, from navigating workplace discrimination to facing barriers in healthcare and housing. these financial growing pains are impacting the well-being of individuals within this diverse community. For more on their insights, we're joined by the hosts of Living Not So Fabulously, David and John Ottenschneider. Great to have you both here with us in studio. Congratulations on the podcast, vodcast. I mean, people can catch it everywhere here in multiple media formats. David, first, as we think about how financial institutions and advisors are empowering LGBTQ plus individuals and couples to achieve financial success, how are we seeing this effectively be navigated right now?
Well, honestly, I think that one of the things that a lot of financial services companies are doing is they're trying, which is great, because we all do want to see ourselves in the firms that we are hoping to either engage with or are already engaged with, right? But I think one of the important things to remember for financial services companies is that not all of their clients are a monolith. John and I like to say that as individuals, when it comes to engaging with our money, it's almost like the Pareto principle. There's an 80-20 split. And that 80% is one side is the finance side, where it is very much the same for everybody. I swipe my credit card the same way you do. I pay with a dollar bill the same way you do. But the 20% is the personal side of personal finance. And that is affected by where I was raised, the color of my skin, my sexual orientation, my gender. All of that has an overshadowing effect as to how we either use or don't use money. And I think financial services companies need to remember that and speak to that when they're working with clients.
Yeah, that's spot on. You recently had Ruth Jacks, who was the Wells Fargo Executive Vice President and Head of Commercial Banking as well, on your podcast. She had a lot to say about her financial growing pains as a member of the LGBTQ plus community. I want to play a clip of this for our viewers here and get your reaction on the other side.
Those were the biggest drivers for me. So when I say I didn't want to be poor, it was that. I didn't want to be hungry, and I wanted to be seen. When I was 20, I would make $20,000 a year. When I was 30, I'd make $30,000. When I was 40, I'd make $40,000.
Make your age.
Yeah. That's exactly right. When I was 50, I'd make $50,000. You get it. So by the time I retired, I'd be set.
Mm-hmm. You're making $100,000 a year and you're 100 years old.
Yeah, that's exactly right. And fabulous.
And so, John, it's challenging to overcome poverty and achieve this type of success. What steps can people in the LGBTQ plus community take to attain that financial security?
Absolutely. The number one step is to start using the tools that are available to build financial security. We did a study in 2022 and 2023 with the Motley Fool. Both years surveyed over 2,000 LGBTQ plus folks and found that by and large, we're not using those tools. Relative to the general population, we're not using retirement accounts, even when we have them available to us. We're not using non-retirement accounts. We're not using mortgages. So two great wealth builders in this country, we're not being included in that for whatever reason, a myriad of reasons. We don't have life insurance the way the general population does. We're also not using wills and trusts, and we all need to have a will or a trust.
Just lastly, while we have you here, when you think about your wealth building plans here, what are some of the biggest topics that you need to discuss with your financial advisor? David, we'll start with you.
Sure. I think probably the most important thing is for folks in the LGBT community is, where are you going to retire? Yeah. When we look across the country, we look for places where we feel like we are safe and welcomed. Oftentimes they're in states or cities that are very expensive. So we need to have that honest conversation with our advisor about where we're going to retire, and do we need to have more in retirement, or maybe do we need to work a little bit longer so we have a larger nest egg so that we can have a fabulous or safe and comfortable retirement.
Right, in a fabulous mansion, in a place with preferably 4 seasons for me. John, I want to get your take though.
Yeah, absolutely. We think that basically what clients need to start doing is sharing with their advisors what their family looks like. What is their family structure? Our dynamic doesn't necessarily look like the general population. So what does our family look like? What do we want to inherit to our children? What do we want to inherit to future generations of LGBTQ plus people?
David and John Ottenschneider, thank you so much for joining me here on the program today. Everyone, you can be sure to tune in to Living Not So Fabulously with David and John Ottenschneider every Wednesday, 12 p.m. Eastern Time. We've got it on all streaming platforms. Coming up, everyone, another federal judge blocks Biden's sweeping student debt relief plan. What this means for student loan borrowers, that's next. It's been a whirlwind type of week for student loan borrowers. President Joe Biden's student loan forgiveness plan has been put on hold once again after a federal judge in Missouri placed an injunction on the president's loan cancellation plan on Thursday. This comes just hours after the president scored a brief victory from another judge in Georgia. For more on what this means for you and for your student loan debt, we've got Jan Miller, who is the president and student loan consultant over at Miller Student Loan Consulting. Great to have you here with us. So let's just dive into this. I mean, how much of a kind of DOA or, blockage is this now that Missouri has essentially just said, you know what, for whatever Georgia said, we're not going to allow this to advance any further?
Yeah. So it really keeps us the same place we were at before. Again, you said the victory was very temporary. It allowed them to proceed with the new, what's called the Plan B program, which is the follow-up forgiveness to the one that was turned down by the Supreme Court last year. This one is more detailed and specific to specific situations. And not long after it was put into place, did the court cases start, lawsuits happen, and the injunction get placed. Georgia lifted it, but then Missouri put it right back on, and we're back to where we were.
And so with this in mind, I mean, for student loan borrowers that have had a flurry of different deadlines that they've had to navigate, especially towards the end of September, and then the crashing of the site, and then an extension of the ability to enroll in a Fresh Start program, where does this really place so much of the future prospect for those who are looking at rates right now and trying to figure out how they can best position their own financial strategy around their student loan propensity, and then on the other side, the amount that they're still carrying right now?
Well, yeah, this is, not only, of course, the injunction on the Plan B, but also on the SAVE program has really, thrown a wrench into a lot of student loan repayment strategies and plans with the anticipation of forgiveness. So a lot of borrowers are in repayment programs that are designed to forgive the loan after a certain number of years. And both the Plan B and the SAVE program are designed to accelerate that forgiveness. And in which case, your cost of the loan isn't based on the typical amortization schedule of a regular loan, principal plus interest over time, but rather off of cumulative payments until the loan is forgiven. So a lot of people have been banking on that, and millions of borrowers now, probably somewhere between 10 and 30 million borrowers potentially could see forgiveness under these programs. And right now they're giving second thoughts to whether they should even be in them.
It's often that we talk about the credit worthiness and how it's impacted by people who are still carrying student loans and in some cases unable to pay over an extended period of time. And that student loans can also impact your financial status when you're either getting married or going into family formation or trying to buy a home. How much of an economic lift would we see if there was a concerted effort to make sure that there is student loan forgiveness?
Yeah, I mean, when loans are forgiven, that frees up a lot of cash flow, right? I mean, now you don't have to make your student loan payment. And some of those repayment terms are 30 years long. So people are in debt for a long period of time. And from my point of view, I see a lot of clients and borrowers who owe many times what they make yearly. So they may make $50,000 a year and owe $150,000. And that's unfortunately far too common, especially for graduate borrowers who get into the biggest amount of debt. So not having a portion of that loan forgiven or an eventual promised forgiveness after a certain number of years makes a huge impact on what they can spend now, and feed into the economy.
Want to give people some actionable tips as they perhaps do a end of quarter check-in on their finances and plot out their spending for the fourth quarter of this year as well here and try to figure out their student loan payment strategy. How can people set and enact an effective strategy to pay down student loan debt?
Well, yeah, and that's the problem with that, with the strategy, is that it's constantly changing, right? This injunction are only a few months old. The SAVE program is only about a year old. The programs keep changing. There's new options. new potential for forgiveness, and then the potential for that forgiveness going away. So, depending on those programs can seem a little bit scary. So you have to constantly reevaluate, because what I tell you now might not be true in a month after the next court hearing. Ultimately, I do believe that a majority of the forgiveness programs, such as public service loan forgiveness and the income-driven repayment plans, will still be around after all these court cases are over. The SAVE program may be gone. It is possible that some of the others might be canceled, but there should be something available for borrowers to receive forgiveness for. And if they're on pace for that right now, I just caution, have some patience, allow this to unfold. Don't take any dramatic changes and try and drop the program completely. Allow this process to take place and then reevaluate. So for now, in most cases, my advice is just to stay put and continue in the programs and allow what happens to happen, see what the rulings are, and then reassess your situation at that time.
All right, a lot of movement. Jan Miller, who is the president and student loan consultant over at Miller Student Loan Consulting. Thanks so much for taking the time, Jen.
Thank you.
Coming up, everyone, it's a bit too early for trick-or-treating, but now is the perfect time to kick off your Halloween shopping. We'll break down where you can score the best deals for all your Halloween needs. I might even tell you what my costume is going to be. That's next. It's officially spooky season, and as Halloween approaches, more shoppers are getting a head start on their preparations. A new survey from the National Retail Federation, known in your hood as NRF, reported that nearly half of U.S. shoppers started their Halloween shopping before October. The NRF projecting that total Halloween spending will hit $11.6 billion this year. That follows last year's record of $12.2 billion. For more on this season's shopping trends, let's bring in Catherine Cullen, who's the National Retail Federation's Vice President of Industry and Consumer Insights. Here, Catherine, great to have you on the program here with us today to break down spooky season and Halloween. I mean, tough comps year over year when you're looking at 2023, but what ultimately is the breakdown that's anticipated here in 2024 and where people are spending on Halloween?
As you noted, near record spending. We're really encouraged by the spending that we've seen from consumers, not just on Halloween, but on other major events this year. We're seeing consumers continuing to embrace these special moments of joy, spending time with family with a lot of energy and excitement. Consumers say they like to shop early because they're getting in the spirit of fall. Or because they love Halloween. Certainly, it's a holiday that has captured many people's imaginations. But in terms of what people will be spending on, certainly costumes capture the biggest portion of consumers' wallets, about $3.8 billion, followed by decorations, which has been a huge driver of the growth in spend since 2019. And of course, candy, all those sweet treats, whether you're indulging for yourself or handing out for trick-or-treaters.
And so with all of this in mind, how much is the average consumer spending on Halloween items this year?
We're expecting consumers to spend about $103 on average for all their Halloween purchases. This breaks down to about $5 less per person than last year, but again, is the second highest in our survey's history. So consumers really getting out there, really embracing this holiday, whether they are, celebrating as adults, celebrating with their kids, or even dressing up their pets.
I already bought one of my costumes. It's a rare year where I might have two, but I told some friends what it might be. Some people, like me, consumers that are shopping earlier this year. Why do you think that is? Why am I doing this?
It's a great question. I'd love to hear that you are considering more than one costume. I've certainly seen that with some folks as well. We are really seeing a number of factors come into play. Consumers have started shopping early for most major events, but also it's because in our mind, Halloween has really become synonymous for consumers with a new season. We know we're coming off of a very, very hot summer for many parts of the country. And while it's still hot for some folks in certain regions, in many parts of the country, temperatures cooled in September. Some folks we follow at NRF, at Planalytics, said that it's the coolest September since 2020 on record. So that seasonal change certainly helped people switch their mindset. People were ready for fall, ready to put away the shorts, bring out the sweaters, ready to decorate, and get in the Halloween spirit this year.
Yeah, ready to carve up some pumpkins, get that pumpkin spice latte going as well. Where can consumers find the biggest savings on their Halloween shopping, though, this year?
Well, we're really seeing it's hard to find a retailer who isn't offering Halloween deals right now. But certainly we know consumers will be shopping at discount stores and retailers. It's become a major portion of our major destination for Halloween shopping, as well as specialty shops and online. For those looking to save, a lot of retailers have said that they're starting their even holiday deals even earlier this year in early October. So certainly some of those could help those Halloween shoppers as well find some great deals on items. And of course, if you're looking to save money, say on shipping or get exclusive access to deals, look into whether a retailer offers a loyalty program. Often that's a way to save a few bucks. Or sign up for their app. Often there are great deals that you can find there, or see if you can pick an item up in store or through curbside rather than having it shipped online, which sometimes can incur some extra costs.
All right, great advice there. Catherine Cullen, who is the NRF Vice President of Industry and Consumer Insights. Thanks so much for taking the time.
Thank you so much. Happy Halloween.
Same to you. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned. Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. You do not want to miss it.